Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when you look at the world of finance today, it's a constant flood of information, right? You've got alerts, high-speed trades, talking heads, yelling on TV. It's a lot. But what if the real key to getting through it all isn't some newfangled algorithm, but just timeless wisdom? Well, today, we're going to dive into the mind of Barton Biggs, a genuine Wall Street wise man who had this amazing habit of looking to the past to figure out the future. And this quote, this is pretty much the heart of his entire philosophy. Biggs was convinced that even though technology, companies, all that stuff changes, the things that really drive the markets, basic human emotions like fear and greed, they stay exactly the same. This one sentence was his ultimate defense against getting swept up in the hype of the moment.
So what really set Barton Biggs apart from the crowd? Well, he wasn't your typical number cruncher. He was much more of a historian, a psychologist even. Let's dig into what made his approach so unique.
I love this idea because it creates such a great contrast. Just picture it. You have the modern trader, right? Surrounded by all these glowing screens and data streams. And then you have Barton Biggs, probably sitting in a room piled high with books, studying centuries of human behavior. He just knew that understanding a little philosophy and psychology was way more important than any spreadsheet if you wanted to have real insight.
And this really gets to the core of it. Biggs had zero interest in churning out hot takes or making daily predictions. His ideas were built on a solid foundation of just reading everything he could get his hands on. He was a guy who would quote poets and philosophers to explain what the market was doing, reminding everyone that at the end of the day, markets are a deeply, deeply human thing.
And this quote just nails it, doesn't it? Biggs basically argued that before you can even try to understand the market, you have got to understand yourself. You have to look in the mirror. Are you the type of person who panics easily? Do you get carried away when everyone's excited? He actually suggested that investors should keep a diary, not just of their trades, but of how they were feeling when they made them. All so you could spot your own biases and patterns. Brilliant!
Okay, so this focus on self-awareness builds right into one of his most powerful beliefs, that history is, without a doubt, our greatest teacher.
This is the why behind it all. Biggs saw the market as this huge, repeating symphony of human emotion. Sure, the instruments might change over time, from Dutch tulips back in the 1600s to dot-com stocks in the 90s, but the actual music, that melody of boom and bust, of fear and greed, well, it plays the same tune over and over and over again. So for Biggs, all these major events weren't just random blips on the radar. He studied them all, panics, wars, geopolitics, because he was looking for the patterns underneath. He knew that after things get crazy high or terrifyingly low, they almost always drift back to the average. He saw these boom-bust cycles, not as a flaw in the system, but as a core, recurring feature of it.
Now this next part is one of my favorite things about Biggs's thinking. He came up with this brilliant way to think about the market not as a what, but as a who. So let's meet Mr. Market.
So imagine the stock market is a person, and this person, Mr. Market, is your business partner. The problem is he's completely unstable. His mood swings are wild. He's not rational at all. He's driven entirely by his emotions. And your job as the investor is to somehow not get swept up in his daily drama.
What a quote, right? It just perfectly captures that feeling every investor has had when the market seems to be doing the exact opposite of what makes sense. Biggs is reminding us here that Mr. Market is designed to test our discipline, to push our emotional buttons until we break. He's not your friend, he's there to mess with you.
And here's a breakdown of his personality. On his manic days, Mr. Market is euphoric. He'll come to you and try to sell you stocks at absolutely insane prices, convinced the party will never end. That's when greed kicks in. But on his depressive days, he's a total mess. He's sure the world is ending, and he'll offer to buy your best assets for pennies on the dollar. And that's when fear sparks a panic. The smart investor, they learn to just ignore his shouting and actually use his mood swings as opportunities.
So if we're supposed to ignore the daily drama of Mr. Market, what should we be paying attention to? Well, for Barton Biggs, the answer was simple. You have to zoom way, way out and look at the biggest picture possible. So instead of thinking in terms of days, weeks, or even years, Biggs got really into these massive 50 to 60-year economic waves. The whole theory came from a Russian economist named Nikolai Kondratieff, who had this idea that capitalist economies move in these huge, long, and somewhat predictable supercycles, usually driven by some big technological innovation. Kondratieff broke this massive circle down into 4 distinct phases. First, you get a long period of growth.
Then, after everything peaks, comes a sharp primary depression. That's followed by a plateau, which is sort of a false prosperity, a time when things feel okay but aren't really growing. And finally, you get a stagnant phase, where things kind of collapse before the whole cycle starts all over again. It's a really powerful lens for thinking about where we might be in the grand scheme of things.
And get this, here's a wild and honestly pretty tragic piece of history. Kondratieff's theory suggested that these big downturns weren't a fatal flaw of capitalism, but that they were natural, self-correcting parts of the cycle. Well, in Soviet Russia, that idea was basically heresy. The commissars were not fans. He was sentenced to a labor camp in Siberia, and he eventually died there.
Just look at this timeline. This really shows you the kind of scale Biggs was playing on. He wasn't worried about last quarter's earnings report. He was looking at patterns that stretched all the way back to the Industrial Revolution and beyond. Now that is what taking the long view really, truly means. So what's the takeaway here? What are we supposed to do with all this? How can the thinking of a 20th century historian help us with our 21st century portfolios? All right, let's bring it all together.
All right, if you're going to remember anything, remember these key principles. First, study history, because human nature never changes. Second, know yourself, your own emotional weak spots. Third, be really careful of the herd. When everybody is running in one direction, it's probably a good idea to at least look the other way. Fourth, take that long view. Zoom out beyond the daily noise. And finally, you have to respect Mr. Market. Don't try to fight him. Just understand his moods and use them to your advantage.
And all of this brings us to one final thought. What Barton Biggs really offers is this powerful alternative to our high-speed, data-obsessed world. He's suggesting that maybe, just maybe, true insight doesn't come from getting more information faster, but from getting a deeper perspective. It leaves us with a pretty provocative question, doesn't it? In a world that's obsessed with what's coming next, is it possible the wisest and most profitable thing you can do is just to slow down and look back?
All right, let's just jump right in. If you want to succeed in investing, where do you even start looking? You'd think the answer is obvious, right? You look forward, to the future. But the legendary investor Barton Biggs, he argued for the complete opposite. He was convinced that the single most powerful tool you have as an investor is a rearview mirror. I mean, that's a pretty bold claim, isn't it? He's not just saying history is, useful. He's saying it's the key. Biggs was absolutely certain that if you have any hope of understanding what's coming next for the economy, for the markets, you first have to go back and understand what already happened. And that begs the big question, right? I mean, come on. We've got new tech, new governments, totally new ways of doing business. So why on earth would the past have any real power to predict today? The world is a completely different place. Or is it? Well, here's the answer, and it's surprisingly simple. Technology changes, politics change, but the one thing that doesn't? Us. Human nature. The raw emotions of fear when the market's crashing and pure greed when it's soaring, those are exactly the same today as they were 100, even 200 years ago. And that's why the patterns keep repeating. Okay, so if these patterns exist, what do they actually look like? Is it all just random chaos? Well, it turns out no. In fact, some economists believe they've found a massive, repeating supercycle hidden deep inside all the data. Think of it like a rhythmic pulse to the entire history of the economy. And this thing has a name. It's called the Kondratieff long wave. It's named after this brilliant Russian economist, Nikolai Kondratieff, who first spotted it way back in the 1920s. His big idea was that capitalist economies move in these huge 50 to 60-year waves. The tragic part of the story? The Soviet leaders, they were not fans of his theory, especially the part where capitalism could fix itself. So they sentenced him to Siberia, and he actually died for these ideas. Now, what's so wild is that you can actually see the wave right here on this chart. Just look at that repeating shape. It's incredible. From the early 1800s, right through the Civil War, World War I, and all the way up to our time, you see it again and again. These massive, multi-decade stretches of growth and rising prices, followed by a sharp crash, and then a long, painful stagnation. It's kind of spooky how consistent it is. Okay, let's break this down into simple terms. Each wave has 4 distinct phases, or seasons you could say. First, you get this long period of growth. Everything's booming. Then, bam, you get a sharp crash, the primary depression. But that's not the end. It's followed by what's called a plateau. It's like a fake recovery, a false prosperity where speculation just goes nuts. And finally, that leads to the stagnation, a much deeper secondary depression that kind of resets everything for the next wave. And this is where it gets a little scary, actually. Just look at how similar these phases can be across different centuries. On the one hand, you have the 1920s plateau, the party right before the Great Depression. And then you compare it to more modern times. What do you see? Major political scandals? Check. Massive debt problems? Check. Rising protectionism? Check. A huge surge in risky financial speculation? Double check. The names and the dates change, but the script feels almost exactly the same. Okay, let's bring this down from the grand theory for a minute and talk about a real human story. Because these cycles, they don't just happen on a chart. They happen to real people. And you know what? Sometimes they happen to the very people who are convinced they're too smart to get caught. So, picture this. It's the 1960s. And hedge fund managers? They were the rock stars of Wall Street. The absolute elite. Barton Biggs called them the financial Green Berets, these guys who could supposedly make a killing in any market, up or down. They were treated like untouchable geniuses, and people were just throwing money at their funds. And then the bear market of 1969 to 1970 hit. And this is what happened to those so-called Green Berets. I mean, look at these numbers. This isn't just a bad year. This is a total wipeout. Wood Park Associates, down 100%. Gone. Vanished. Buttonwood and Associates, same story, 100% loss. Even A.W. Jones, the firm that basically invented the hedge fund, down 86%. Turns out, being a genius doesn't make you immune to history. And the financial devastation, that was only part of it. The psychological toll was just brutal. Biggs tells this one story about a really well-known manager who, when the crash hit, literally went to bed and just stayed there, refused to get up. His wife ended up having to sell everything and shut down the fund. It's a powerful reminder that these numbers on a screen, they represent real human pain. So, a story like that really challenges our modern sense of safety, doesn't it? It forces us to take a hard look at one of the most fundamental beliefs we have about investing, a belief that might just be a myth. You know the saying, right? We've all heard it a million times. Stocks for the long run. Just buy a good portfolio, hold on tight, and no matter what, you'll come out on top. It's a really comforting idea. And, to be fair, for a lot of recent American history, it's pretty much worked. But history presents a much, much scarier possibility. It asks a question we don't like to think about. What if a market doesn't just go down for a little while? What if it dies? What if it gets shut down completely, just wiped off the map for years, maybe forever? Just take a look at this list. Throughout the 20th century, this wasn't some theoretical risk. It actually happened. Entire stock markets were just closed. Gone. Russia in 1916, thanks to a revolution. China, Poland, invaded. Germany, not once, but twice. Your buy and hold strategy doesn't mean a whole lot when the market you're holding just ceases to exist. This is a risk that, honestly, we've almost completely forgotten about today. And speaking of reality checks, this historical view really helps put our own expectations in perspective. Get this. Surveys show that most investors today expect to make over 15% a year on their money. But when you look at the actual historical data for 39 different global markets, the median real return, that's after you subtract inflation, is only 1.5%. That's not a gap. That's a chasm between what we expect and what history has actually delivered. Okay, so what's the point of all this? Is the big takeaway to be terrified? To just run for the hills and stick your money under the mattress? No. Actually, not at all. History has one last lesson for us, and it's surprisingly optimistic. This, to me, is the most incredible part of the whole story. Despite everything we've talked about, the wars, the depressions, the markets that literally died, equities, or stocks, have shown this incredible power to bounce back. The research actually shows that over the very long run, the real returns from stocks in Germany and Japan, countries that were literally reduced to rubble, were higher than in most of the countries that got through the wars relatively untouched. And that brings us right back to the ultimate conclusion from Barton Biggs. History absolutely supports the cult of the equity, as he calls it. It shows that stocks really are the best way to generate real wealth over time. But, and this is the but that changes everything, it only works if you can survive the journey. You have to be able to hang on through what he called the air pockets, those terrifying stomach-churning drops that are guaranteed to happen. And so that's the real question that history asks every single one of us. The question isn't, will stocks be higher in 50 years? Because yeah, they probably will be. The real question is, do you have the financial and, just as importantly, the emotional strength to survive the brutal downturns that history guarantees are coming? Are you truly prepared for the air pockets? Okay, let's go back in time to 1997. The global economy was at this massive crossroads, and you had two powerful, completely opposite visions for its future that were basically at war with each other. One side saw this coming inferno of inflation, while the other saw a creeping, disruptive ice age of falling prices. We're going to dive deep into this fundamental economic battle, fire versus ice. And this famous poem by Robert Frost, it just perfectly captures the high-stakes nature of this whole debate. I mean, this wasn't just about some dry economic models. It was about two fundamentally different futures for the entire world, a future of fire or a future of ice. So here are the two camps. On one side, you had the traditionalists. Let's call them Team Fire. They were arguing that the world was on the verge of this big, synchronized economic expansion that would just inevitably lead to overheating and rising prices. You know, the classic story. But on the other side were the revolutionaries, Team Ice, and they believed that powerful new forces, think globalization and technology, were fundamentally changing the game, creating this environment of permanent downward pressure on prices. All right, let's start by looking at the arguments from Team Fire. And you know, they weren't just guessing. They were looking at decades of economic history, from the post-war boom all the way to the stagflation of the 70s, that really seemed to prove their point. What's really striking is just how confident the Fire camp was. I mean, to them, this wasn't some theory. It was a proven fact. The Phillips curve was their bedrock, this core idea that as unemployment falls and an economy heats up, wages and prices have to rise. It's just how things had always worked. And this was a multi-pronged argument. So first, you had the Phillips curve, which we just saw, but they also believed that for the first time in a while, all the world's major economies, the US, Europe, and Japan, were going to be growing strongly at the exact same time, creating this massive demand. Then, of course, there was the political angle, the idea that politicians will always choose spending to get reelected, which creates this natural inflationary bias. And finally, the belief that heavily indebted governments would find it way easier to just inflate away their problems than to pay them back with sound money. But what if the old rules just didn't apply anymore? That was the really radical idea behind Team Ice. They argued that the world had fundamentally changed. So let's see how they built this completely different picture of the future. This quote right here gets to the absolute heart of the ICE argument. See, they weren't predicting a recession. They totally agreed the economy could grow. Their point was that even with strong growth, inflation wouldn't show up because of a massive global oversupply of pretty much everything: labor, factories, you name it. So here's how that all breaks down. First, globalization. You had hundreds of millions of new workers in developing nations entering the global labor force, which put a permanent lid on wages everywhere. Then you had excess capacity. From sneakers to semiconductors, there was simply too much ability to produce things, forcing constant price competition. Technology was also a huge piece of this, driving massive productivity gains and slashing costs. And the proof was right there in the pudding. Companies themselves were reporting that they just couldn't raise their prices even when business was booming. The proponents of ICE saw their theory as a classic hedgehog idea. You know that saying, right? The fox knows many little things, but the hedgehog knows one big thing. For them, this global oversupply wasn't just one factor among many. It was the one big, transformative concept that explained everything about this new economy. And they had a powerful, real-world example to point to: Japan. Back in the early 90s, Japan's massive stock market bubble burst. The economy just stalled out and deflation started to set in. So in response, interest rates on bonds totally collapsed. But here's the fascinating part. Even with rates falling to unbelievably low levels, the stock market didn't recover. It was a liquidity trap, a perfect real-time model for what an ICE world could actually look like. Okay, this is where the ICE thesis gets truly radical. It wasn't just about inflation anymore. It was about how this new environment would completely reverse the long-standing rules of investing that everyone had lived by for decades. The ICE camp actually proposed a specific tipping point, an inflation sound barrier at around 1.5%. They argued that once inflation fell below this level for a sustained period, the entire relationship between stocks and bonds would just flip on its head. They called this phenomenon the controls reversed. For 40 years, investors lived in a world where strong economic news was actually bad news for both stocks and bonds, because the big fear was always inflation, forcing central banks to raise rates. But in an ice world, the primary fear flips to deflation and falling profits. So good economic news suddenly becomes great for stocks. It means higher profits, but it's actually bad for bonds because it lessens the fear of recession. It's a complete paradigm shift. This table makes that contrast incredibly clear. In a fire world, a strong economy hurts both stocks and bonds. But in an ice world, a strong economy splits the market. It's great for stocks, but bad for bonds. For anyone trying to build a balanced portfolio, understanding which world you're actually in is, well, it's everything. This was a radical shift in how investors needed to think.
So who won the debate back in 1997? Well, in the years that followed, the ICE scenario of low inflation, globalization, and falling interest rates largely played out. But honestly, that's not the most important takeaway for us today. The real value of this framework is realizing that fire and ice aren't one-time events. They are two permanent competing forces. The inflationary pressures of government spending and tight labor markets are always battling the disinflationary forces of technology and globalization. Understanding this constant tug of war is the real key.
And that brings us right to the present. The same battle is still raging on, with the arguments shifting back and forth. So the crucial question for all of us is, as you look at the world right now, which force do you think has the upper hand? Is the world being lit by fire, or is a deep ice creeping in? The answer to that will shape your entire financial future.
Welcome to The Explainer. Today, we are talking about one of the most reliable stories in all of human history. The cycle of financial mania, the panic, and of course, the crash. It's a story that proves again and again that when it comes to money and crowds, what's past is never really past. It's just a preview of what's coming next.
You know, this quote from Walter Bagehot, the first editor of The Economist, just kind of nails it. He really, if a little bluntly, lays out the core ingredients for every single bubble. A whole lot of easy money sloshing around, and a whole lot of eager people ready to throw it at something. That combination? It's basically the gasoline and the match that starts the fire every time.
So to really get a handle on this cycle, we have to start by looking in the mirror. Because these manias, they aren't really about spreadsheets or stock charts. They are fundamentally about us, about human psychology and the totally predictable way we act when we're in a crowd.
Right at the heart of every panic is this tricky little idea called the fallacy of composition. Think of it like this. You're in a crowded theater and someone yells, "Fire!" The rational thing for you to do is run for the exit. But when every single person has the exact same rational idea at the exact same time, you get a stampede, you get a disaster. Everyone acting in their own best interest ends up creating the worst possible outcome for everybody.
And if you're sitting there thinking, okay, but I'm too smart for that, I wouldn't get swept up in the hype, well, history has a pretty powerful story for you, and it features one of the certified geniuses of all time.
Yep. Sir Isaac Newton, the man who gave us the laws of motion and gravity, said these exact words during the massive South Sea Company bubble back in 1720. He saw it coming, he knew it was crazy, but even he couldn't resist its pull.
So here's how his tragic little financial story played out. Newton, being a genius, acts rationally at first. He sells his shares and doubles his money, a huge win. But then he had to sit there and watch his friends, who stayed in, get even richer. And that feeling, that fear of missing out, that FOMO, it just ate him alive. He caved, jumped back in with way more money right near the peak, and got completely wiped out. He lost a fortune, and it's said that for the rest of his life, nobody was allowed to even say the words South Sea in his house.
So if a mind like Newton's can be overpowered by crowd psychology, imagine what happens when an entire country gets infected. To see that in action, we've got to break down the most famous, most legendary bubble of all time.
Tulipomania.
For just a handful years in the 1630s, the Dutch, who are normally a pretty sober and conservative bunch, went absolutely crazy for flower bulbs. It started as a hobby for the rich, but it quickly spiraled into a nationwide speculative frenzy that sucked in everyone.
We're talking about prices that are just hard to even wrap your head around today. A single, rare tulip bulb could sell for the modern equivalent of over $100,000.
That was more than a fancy house on a canal in Amsterdam. For a flower, that might not even bloom.
And this wasn't just some numbers on a ledger, it completely twisted Dutch society. You had people from every walk of life dropping everything. Farmers sold their animals, people mortgaged their homes. Normal business just ground to a halt because everyone was chasing this dream of getting rich off tulips. They even created brand new financial markets just to trade the rights to these bulbs.
And then, one day in 1637, it just stopped. There was no big event, no terrible news. A couple of people tried to sell, and suddenly they realized there was nobody left to buy. The confidence, the only thing holding the whole thing up, was gone. It vanished overnight. The crash was instant, it was brutal, and it threw the country into a depression that took years to recover from.
Now, it's so easy to look back at the tulip craze and just laugh at how absurd it all was. But here's the thing you absolutely have to understand. This same pattern, this exact same psychology, it just keeps happening. The only thing that ever changes is the tulip.
Let's fast forward to the 1980s. The tulips were long gone, and now people were speculating on real estate, junk bonds, even magazines. But the game was identical. Buy something not because you think it's valuable, but because you're totally convinced some other sucker will buy it from you for more. The writer Michael Thomas really captured the feeling of the time, didn't he?
But maybe the most perfect, most vivid modern replay of tulipomania was the dot-com bubble in the late 90s. I mean, the language they used was almost exactly the same. The Dutch told themselves the world would always want their special tulips. The tech gurus told us that the new economy had changed the rules of business forever. Sound familiar?
And this whole new mania was really running on the same flawed logic as the tulips. It was just wearing a new tech outfit. There were two giant delusions propping the whole thing up.
All the old, boring rules of investing? They were just thrown right out the window. A company making a profit? Who cares? They didn't even need a plan to make a profit. In fact, having a long history was almost seen as a bad thing. It meant you were old and slow. The most exciting companies, the ones worth the most, were the ones that were just an idea, living in this state of pure possibility.
So, okay, we've seen this pattern play out over and over, from flower bulbs to internet stocks. So what? What are we supposed to learn from all this? How can we get ready for the next time this inevitably happens?
You know, they say fortune favors the prepared mind, and history doesn't just give us these wild, entertaining stories. It actually offers us a pretty clear set of lessons, a kind of survival guide for anyone who wants to ride the next wave of craziness without getting wiped out like Isaac Newton. All right, so here's the survivor's guide. First, be ready to get out when a displacement event happens. That's just a fancy term for something big that changes the whole story, like a game-changing new technology or a war. Second, you have to avoid Maginot-Line psychology. The French built these incredible defenses to fight the last war, and they got crushed. In investing, it means you can't assume the next bubble will look exactly like the dot-com bubble. Next, and this is huge, you got to recognize that these manias are always fueled by easy money and cheap credit. And finally, the most important lesson of all, the objects of speculation change, but people don't. Greed and fear are forever.
And really, that brings us right to the end. We know, for a fact, this cycle is going to happen again. Greed and fear are just part of our DNA. So the only real question left for us to think about as we look around the world today is, what's it going to be this time? What will be the next tulip? What's going to be the object of the next great mania? Because it's out there, waiting.
Imagine you're trying to invest your money, but it feels like the world is on fire. All the rules you thought you knew, they're changing by the minute. Today, we're going to do something a little different. We're going to look over the shoulder of a brilliant investor, a guy named Barton Biggs, and see how he made sense of 3 world-shaking crises. And the key is, we're not looking back with 20/20 hindsight. We're seeing it as he saw it, in the chaotic moment it was all happening. How all that raw information, those rumors and data points, get turned into a real investment idea.
So it all boils down to this one big question, right? How do you make sense of total chaos when the future is a complete unknown? Well, we're about to see exactly how one person navigated the fog of 3 absolutely pivotal moments in the late 20th century. And we're starting with a crisis that really did bring the world to the brink.
Okay, our first stop, January 1980. The Cold War is anything but cold. The Soviet Union has just shocked everyone by rolling its tanks into Afghanistan, and you can bet global markets are in an absolute panic. The official story? Well, it's all about calculated geopolitical chess. But what if the real story, the one that truly mattered, was something else entirely?
This is where it gets interesting. Biggs hears a rumor, a story making the rounds in intelligence circles that sounds more like a spy thriller than a dry government report. And this one quote, it hints that this invasion wasn't some cold, calculated strategy, but something way more personal and way more violent.
You see, according to this story, this wasn't a policy decision, it was a revenge killing. Get this. A top Soviet general, their #1 arm twister, is sent to convince the Afghan president. The meeting goes south, it turns into a shouting match, a gun comes out, and the Soviet general ends up dead. Just hours later, Moscow unleashes hell on the presidential palace.
So here's the crucial difference. You've got the official story on one side, a strategic play for Middle East oil. But on the other, you have this hot blood theory, an impulsive, furious, emotional reaction. Now, for an investor like Biggs, this changes everything. An emotional, unpredictable enemy is a totally different kind of risk than a cold, rational one.
And these shockwaves weren't just being felt overseas. Back in the US, the crisis was feeding this deep economic anxiety. You can see it right here in these charts. There was this huge shift in how people felt. Americans were losing faith. By 1979, almost 90% of people thought inflation was here to stay, and they knew exactly who to blame: the government.
And that feeling of losing control, it caused this massive reversal in how people thought about American power. I mean, just look at these two pie charts. They're only 8 years apart. In '71, after Vietnam, almost half the country wanted to cut defense spending. But by 1979, the mood had completely flipped on its head.
60%. I mean, think about that jump. From just 11% of Americans wanting more military spending to 60%. That's not just a poll result, that's a seismic shift. It was basically a public mandate for a much more muscular foreign policy, a direct reaction to the weakness they were seeing on the world stage.
All right, let's jump forward a decade to August 1990. The Berlin Wall is down, the Cold War is over, and there's this feeling of post-Cold War euphoria in the air. That is, until Saddam Hussein invades Kuwait, and suddenly the world is facing a brand new kind of crisis, one designed for an era with only one superpower.
Biggs saw it right away. He knew this wasn't just a one-off. This quote here, it just nails the new threat perfectly. The old game of superpower chess was over. The new danger? It was going to come from these regional bullies, testing the limits of what they could get away with.
And for the markets, the fallout was immediate and it was harsh. U.S. credibility took a serious hit. The world's biggest oil reserves were now in the hands of a fanatic. And that peace dividend everyone was so excited about after the Cold War, yeah, that just evaporated overnight. For investors, it meant one thing. The price of risk on everything just went way, way up.
And all this led Biggs to ask a question that just cuts right to the heart of the problem. What's the point of spending hundreds of billions on all this incredible military hardware if you're too afraid to actually use it to protect your interests? It was a question that laid bare just how vulnerable a superpower could be in this messy new world.
And that brings us to our final snapshot, 1999, right on the edge of a new millennium. And the threat? It's evolved again. This time, it's something way more insidious, something invisible, and frankly, something absolutely terrifying: bioterrorism.
And the analysis of this new threat starts with this bone-chilling warning from the U.S. Secretary of Defense himself. You know, this wasn't some fringe idea. This was the assessment coming from the very top. The old rules of deterrence, you hit us, we hit you back 10 times harder, they were suddenly useless.
This is what he called the superpower paradox. Think about it. America's military was so powerful that nobody could possibly challenge it head-on. It would be suicide. So instead of fighting a war they were guaranteed to lose, the enemy was forced to get creative. They had to find these asymmetric ways to attack, to go around the military and strike right at the heart of the country.
And their weapons of choice? They were the stuff of nightmares. Anthrax, Ebola, smallpox. There was even talk of a horrifying hybrid nicknamed blackpox. And what made it so incredibly dangerous was that former Soviet bioweapon scientists, the people who knew how to make this stuff, were basically freelancers, selling their deadly expertise to the highest bidder.
Just look at this number. 1 million. That's how many people could be infected by a single gram of anthrax, an amount so tiny you could hide it almost anywhere. It's a scale of destruction it's almost impossible to wrap your head around, and it's delivered by an enemy you can't even see.
Well, and fighting an invisible enemy like this, it forces an impossible choice on all of us.
It's a direct clash between our privacy and our protection. Because to stop terrorists who operate in the shadows, intelligence agencies say they need more access, more data. But that access comes at the expense of our civil liberties, and it kicks off this huge debate about how much freedom we're willing to give up to feel safe.
So, after looking at these 3 different moments of fear, what's the big takeaway? Well, when you put them all together, you can see this clear and frankly pretty troubling evolution in the kind of risks we face.
This timeline really puts it all into perspective, doesn't it? We went from the familiar danger of one state versus another in 1980 to the rise of regional bullies in 1990, and finally to the shadowy world of asymmetric warfare and non-state actors by 1999. The threats just kept getting smaller, harder to see coming, and in some ways, even more catastrophic.
Which leaves us with one last really urgent question. Barton Biggs was always trying to spot the next threat before it became obvious. So, if we follow his logic, what does the asymmetric threat of our time look like? Is it cyber warfare? Is it disinformation campaigns? Economic attacks? That's the question this whole journey forces us to ask ourselves right now.
When you picture a Wall Street legend, you probably imagine a mathwes, right? Someone buried in algorithms and complex formulas. But what if I told you one of the greatest market predictors of the 20th century was actually a historian? That's the incredible story of Barton Biggs, an investor who was convinced that the key to unlocking the future was hidden in the pages of the past. And this, quote, this was his entire worldview in a nutshell. Biggs just got it. He knew that markets aren't these cold, perfect machines. No, they're messy, they're emotional. They're just the sum total of millions of individual human hopes, fears, and crazy biases. For him, economics wasn't physics. It was basically sociology with a stock ticker. And that perspective? Well, it gave him a massive edge. So just as Wall Street was falling in love with quantitative models and computerized trading, Biggs went in the complete opposite direction. He doubled down on what he called a carbon-based approach. He focused on people, on their irrationality, on the messy, unpredictable drama of human nature. He was convinced that no computer could ever truly model the greed and fear that really drive booms and busts. Now, this focus on humanity led him to his first big principle, a really deep skepticism of pessimism. He looked back through history and saw this pattern again and again, where the smartest people in the room would confidently predict that everything was about to fall apart. He absolutely loved this quote from the historian Barbara Tuchman. The coping mechanism? That's the secret sauce. It's this simple but powerful idea that crisis always sparks innovation. It's the one variable that all the doomsayers, with their neat and tidy straight-line projections, they always forget to account for human ingenuity. And he had some killer examples to back this up. Think about Thomas Malthus back in the 18th century. His logic was perfect, his math was sound, he predicted mass starvation. But he couldn't possibly imagine the coping mechanism, the Green Revolution, with fertilizers and tractors that created an era of unbelievable food surplus. And then it happened again a century later. An economist named W.S. Gibbons looked at England's coal use and predicted a total energy collapse. It seemed inevitable. The coping mechanism, not time? Boom, the discovery of oil halfway across the world in Pennsylvania, a totally new paradigm that nobody saw coming.
This one's my absolute favorite. In the late 1800s, serious urban planners predicted that, based on population growth, the streets of New York City would soon be buried under a foot of horse manure. Every single day. They just extrapolated the number of horses. They couldn't predict the real game changer, the automobile. Time and time again, the coping mechanism wins. Okay, so if you can't just trust straight-line predictions, how do you figure out what's going on in the world? Well, this brings us to the most creative and, frankly, kind of brilliant part of Barton Biggs's whole method. He didn't just study history, he tried to get inside the heads of the people who are making it. You heard that right. To really understand what was happening, he would write these fictional diary entries from the perspective of world leaders, guys like Mikhail Gorbachev, Deng Xiaoping, even Saddam Hussein. It was this incredible thought experiment to get past all the official statements and diplomatic jargon and into the raw, cynical, strategic thinking that was really driving world events. Now check this out. By imagining he was Gorbachev, Biggs saw the Soviet Union not as this terrifying superpower, but as a crumbling empire. An empire so desperate it was banking on the West's own greed to finance its survival.
He's using that old line, about the capitalists selling the communists the rope to hang themselves with. It just shows the level of desperation he was sensing. And then, flash forward to 1989, right in the middle of the Tiananmen Square crisis, Biggs channels Deng Xiaoping. And he just cuts right through all the global outrage to the ice-cold calculation at the center of it. Foreign investors, at the end of the day, care more about stability and making money than they do about democracy. And knowing that was the key to figuring out what would happen next. And this is where it gets really powerful. You can literally see his qualitative insight, his diary entry, playing out in the hard numbers of the Hong Kong stock market. Look at it. The market completely tanks after the massacre. But then, it starts to creep back up as investors process that brutal order that Deng had just reimposed. It's a perfect link between psychology and the price. So Biggs took this same historical, psychological lens and applied it to the brand new world that was emerging after the Cold War. While most people were popping champagne and celebrating the end of history, Biggs saw a whole new set of dangers lurking just beneath the surface. This imagined diary entry from Saddam Hussein right after the first Gulf War is just chilling. Biggs saw how a dictator could cynically use the language of global finance, talking about emerging markets and IPOs, all as a giant scam to rebuild his power, only to seize everything later. It was a huge warning about the dark side of globalization. So what's the bottom line here? By looking at history, Biggs basically foresaw the major conflicts of the next 2 decades. He knew from history that decaying empires are incredibly dangerous. He predicted the rise of regional bullies who were no longer kept in check by the US and the Soviets. And get this, he argued that a world with just one superpower might actually be more chaotic and unstable, not less. Okay, so all this historical analysis is fascinating, but you're probably wondering, did it actually work? Did it make any money? The answer is a massive yes. This unique way of looking at the world led to some of the most legendary and profitable market calls in modern history. I mean, the proof is in the pudding, right? In 1980, when everyone was freaking out about high interest rates, he said, buy stocks, and caught one of the biggest bull markets ever. In 1989, when everyone thought Japan was going to own the world, he saw the bubble was about to burst. And most famously, he called the dot-com crash in 2000 one of the largest bubbles in history. The guy was a true sage. In this quote right here, which he actually borrowed from Warren Buffett, it just perfectly sums up the discipline that came from his worldview. It's like being a batter in a baseball game where the umpire can't call you out on strikes. You can just stand there, let pitch after pitch go by, all the fads, all the manias, and just wait for that one perfect pitch. That one moment when the market story gets so crazy it completely disconnects from reality. And that really leaves us with a huge question for today, doesn't it? In our world, a world that is becoming more and more dominated by AI, big data, and algorithms, is it possible that the most powerful advantage, the real secret weapon, isn't a better model, but a deeper understanding of the timeless, messy, and fundamentally human story of who we are?
Okay, picture this. It's 1981. The world economy is completely stuck in this nightmare called stagflation, where growth is dead in the water, but inflation is just soaring. The old economic playbook, totally useless. And then, out of nowhere, this radical, almost wild idea pops up, and it promises to turn everything around. So let's dive into the story of how this one controversial theory completely rewrote the rules of economics.
Right at the center of all this was a group that the establishment just could not take seriously. I mean, you had these professors, Robert Mundell and the very colorful Art Laffer, a journalist, Jude Wanniski, and then you have Congressman Jack Kemp, who used to be a pro-quarterback. To the old guard, the Keynesian economists, these guys were a total joke, just a motley assortment pushing what they saw as a dangerous new religion.
So, what was this new creed? What was this core belief that made the old guard so angry but absolutely captivated a whole new political movement? Well, that's what we're going to unpack right now.
To really get the impact of this thing, you first have to understand just how revolutionary it was. We're talking about the early 1980s, and this wasn't just some slightly different policy idea. No, this was seen as a full-blown heresy against everything the economic world believed to be true.
And this slide, well, it lays out the clash perfectly. For 50 years, Keynesian economics was king. The idea was simple. The problem is people aren't buying enough stuff. Weak demand. The solution? Government needs to spend more money to get consumers going. Supply-siders came along and just flipped that whole idea completely on its head.
They said, no, no, no. The real problem is that we're not making enough stuff, inadequate supply. So their solution was, let's cut taxes to unleash the producer, the person building the factory, the person working the extra shift, the entrepreneur with the new idea.
And here's the really ironic part. The same establishment thinkers who were calling supply-side economics a heresy, they kind of forgot that their own hero, John Maynard Keynes, got the exact same treatment back in the 1930s. He was the radical, the heretic. So what was now the boring conventional wisdom was once the crazy new idea. It was like history was hitting rewind.
Okay, so this wasn't just some philosophy. It was a practical plan. And to really get it, we have to clear up a huge misunderstanding about the tax cuts. They weren't just one big, simple move. They were actually designed as a very specific two-pronged attack on stagflation.
So here's the key thing to understand. The tax cuts had two completely different targets. For the wealthy, cutting those super high marginal tax rates wasn't just about giving them more money. The idea was to convince them to pull their cash out of unproductive tax shelters and instead invest it in things like new factories and new businesses. Then, for everybody else, for the workers, cutting income taxes was less about saving and more about increasing the reward for working. The incentive was, hey, if you work more, you keep more, which means more people working and, yes, also more people spending.
But, a lot of people just didn't get this two-part strategy. It was mostly misunderstood, even ridiculed. Critics, like in this famous Doonesbury cartoon, just laughed at the idea that your average Joe was going to take his little tax cut and go build a steel mill. And, well, they were missing the entire point. The average person's tax cut was meant to make them want to work and spend more. The investor's tax cut was the one designed to finance the steel mill. The two parts were supposed to work hand in hand.
Of course, a theory is one thing, but reality is something else entirely. By 1982, this brand new economic model slammed head-on into a really nasty recession, and that created a massive crisis of faith.
By 82, things were looking pretty grim. The recession was deep, and it just wouldn't let go. And to make matters worse, other taxes like for Social Security and gasoline were actually scheduled to go up, which totally undercut the whole idea of a stimulus. So the program got hit from all sides, criticized for not being bold enough, for failing because, as some said, it wasn't true to itself. And all this created this huge social tension, this growing divide between the people paying taxes and the growing number of people getting government checks.
And you can see the main culprit for all this pain right here. See that massive spike on the right? That's the real interest rate. To kill inflation, the Federal Reserve had jacked it up to absolutely punishing levels. This was completely choking off the very investment and growth that the tax cuts were supposed to create. It was like hitting the gas and the brake at the exact same time. There's this quote from back then that just perfectly nails the feeling of the time. It said it felt like some invisible hand was running the movie of the 70s backwards. All the inflation, the debt, the economic funk of the 70s, it felt like it was all being undone, but the process was just chaotic and really, really painful.
And this wasn't just an American problem. Oh no, this crisis was global. The entire world was staring down the barrel of a massive debt problem that was threatening to drag everyone down with it.
By 1983, developing countries owed an incredible $900 billion to international banks. It was described at the time as a great, bloated, prehistoric, two-headed python that was about to strangle the entire global economy. A whole decade of fake prosperity built on borrowing was finally coming due.
The medicine for this global sickness has a name: disinflation. And think of it like this. The whole world had been on a decade-long shopping spree with a credit card. Disinflation was the painful moment when the bill arrived. It meant jacking up interest rates and slashing spending to finally pay down all that debt. It had to be done, but man, it also meant a period of really slow, painful growth for pretty much everyone.
Now this chart tells a really important part of the story, that underlying tension. The dotted line, that's government aid, stuff like Social Security and welfare. The solid line is the value of the entire stock market. And you see that point where they cross, right around 1970? That is the moment that the value of government promises officially became bigger than the value of the entire productive private economy. Flipping that trend was really at the core of the whole supply-side project.
So really, it all boiled down to this one simple, hard truth. The entire world, from poor countries to rich ones, had spent a decade living way beyond its means, all of it financed with a mountain of debt. The party was officially over. It was time to pay the piper.
And out of all this pain, all this crisis, the core principle of the supply-side movement got clearer and stronger than ever. By 1985, it had basically hardened into this one simple, non-negotiable idea: a stand against government spending.
This story from 1985 is the perfect example. Washington was worried about the budget deficit, and basically the entire establishment, we're talking Republicans and Democrats, came up with what they thought was a sensible compromise: a new tax on imported oil. But President Reagan shot it down instantly. Why? Because the experience of the past few years had forged this one core belief: you can't shrink government by giving it more of your money. The only way to really force politicians to cut spending is to starve the beast by cutting off its revenue.
And this wasn't some radical new thought. This principle goes all the way back to the foundations of modern economics. Adam Smith himself said it back in 1776. Basically, the common sense a family uses, don't spend more than you earn, should apply to a country too. The supply-siders of the 1980s saw themselves as just bringing back that timeless, simple wisdom.
That economic revolution of the 1980s completely changed the global conversation. It shifted the whole focus from managing demand to unleashing supply. Back then, the solution seemed pretty clear: cut spending and cut taxes. Which, of course, leaves us with a huge question to think about today. As we face our own economic challenges, massive debt, weird new kinds of inflation, are those same tools still the right answer?
So let me ask you something. Are you drowning in information but absolutely starving for judgment? If you're an investor, I'm guessing that question hits pretty close to home. In this explainer, we're going to distill some timeless wisdom from a true Wall Street legend to give you some real actionable insights on how to thrive.
You know that feeling? It's what the legendary investor Barton Biggs called the investor's massive organizational problem. It's that daily flood of financial news, all those reports, all that noise. We're just constantly buried in what he called repetitious trivia, right? Compulsively scrolling, just hoping we find that one magic little nugget of information that's going to unlock some brilliant decision.
So, to help us cut through all that noise, we're going to build a framework for disciplined thinking, and it's all based on Biggs's incredible writings. Here's how we'll break it down. First, we'll tackle the investor's dilemma. Then, we'll get into the 3 pillars: judgment over information, playing the winner's game, and believing against the crowd. And finally, we'll wrap it all up with how this gives you the disciplined investor's edge.
All right, let's dive right in. The crazy thing is, Biggs pinpointed this core problem way back in 1983. And you have to admit, it's a dilemma that's only gotten 1,000 times more intense in our hyper-connected world today.
And here's the real kicker, the real danger. All this compulsive reading, it's not just a waste of time. Biggs warned it can actually work against us. How? Well, it reinforces the very conventional wisdom we should be questioning. It kind of turns us into followers when we really need to be independent thinkers.
Okay, so if the problem is just too much information, what's the solution? Well, this brings us to the very first pillar of discipline, and it requires a pretty radical shift in your mindset. It's all about changing your entire goal from just collecting information to producing something way more valuable.
Biggs absolutely loved this quote from the philosopher John Locke, and you'll see why. It makes such a crucial distinction. I mean, what's your real job as an investor? Is it just to be informed? Biggs would give you a hard no. He put it this way: judgment, not knowledge or information, is the final and only product of the investment manager. See, information is just the raw material. Your judgment, that's the finished product.
And this slide just captures that difference perfectly. I mean, look, on the left, you've got the information collector, literally buried under a mountain of paper, just confusing being busy with being productive. But then on the right, you see the judgment producer. This person has stepped away from the pile. They're carving out time to actually think, to really chew on the portfolio and, as General MacArthur put it, to separate that vital 5% of intelligence from the trivial 95%.
Okay, so developing that judgment is a huge first step. But what happens when that judgment gets tested? You know the feeling. Your portfolio's down and every single instinct in your body is screaming at you to do something. Well, that brings us right to our second pillar, the power of patience.
You know, Biggs went right after that popular idea that active managers are playing a loser's game. They just can't win. He argued that no, the greatest investors absolutely do win. But, and this is a big but, their victories aren't a sprint. They're a marathon. And that marathon has plenty of rough patches along the way.
And wow, this chart shows you exactly what that marathon looks like. The power of long-term outperformance is just staggering. Look at this. Over 31 years, John Templeton turned 10 grand into over $600,000. Now that same 10 grand in the Dow, just 35,000. That enormous gap, that is the prize for playing the winner's game.
But here's the catch, and honestly, it's the part most people completely miss. Even the legends, the absolute superstars, have long, painful cold spells. Biggs' research showed that guys like Templeton actually underperformed the market in as many as 30 to 40% of the year studied. Just let that sink in for a second. We're talking about lagging the market for 3, maybe even 4 years in a row.
And this is where discipline becomes absolutely critical. Biggs saw that these cold spells were almost always followed by these sustained bursts of spectacular returns. So his advice? It was completely counterintuitive, but it was crystal clear. Firing a proven manager during a rough patch is one of the most costly mistakes you can possibly make. In fact, he argued you should be thinking about giving the cold guys more money, not less. Can you believe that?
So look, having the patience to stick with a great manager, that's one thing. But what about when you're the one making the call? This brings us to our final and maybe the most difficult pillar, developing the courage of your own convictions, especially when the rest of the crowd is running for the hills.
Let's just travel back in time for a second. Look at this chart from 2003. The market had just been through that brutal dot-com bust, a nasty 3-year bear market. And as you can see, valuations in the UK had totally reset. The bubble had been, as Biggs so powerfully put it, expurgated, wiped out. And yet, what was the mood? The consensus was just overwhelmingly gloomy, uncertain, and plain old scared.
I mean, this was the prevailing wisdom of the day. It was just a laundry list of fear. Everybody knew these things were true. Deflation is the real danger. The American consumer is tapped out. The housing bubble is about to burst, and so on. But Biggs, he argued you should question these assumptions precisely because everyone believed them. The consensus had built this giant wall of worry, and for a true contrarian, that wall, that's an opportunity.
And this really gets to the heart of his insight. He said, you have to be invested before it's obvious, because by then it would be too late. It's so simple but so profound. If you wait for the all-clear signal, if you wait until the happy ending is obvious to every single person out there, well, guess what? All the real gains are already gone. The biggest returns are earned by having the conviction to invest when things look absolutely bleak.
Okay, so let's tie this all together. How do these 3 pillars, judgment, patience, and conviction, combine to create a really powerful long-term advantage for you in the market?
The thing is, the real edge doesn't come from some secret formula or a magic piece of info you found scrolling online. No, it comes from a disciplined process. It's about building a mental framework. First, cultivate your judgment. Prioritize thinking over just collecting data. Second, practice patience. Understand that even the best strategies hit cold spells, and you gotta stick with them. And third, develop real conviction. Question the consensus and act on your beliefs, especially when it feels uncomfortable.
So in the end, it really all comes down to a choice, doesn't it? You can choose to just react to the market's endless data, all that noise, or you can choose to operate with a clear, disciplined mindset. The market provides the data. Biggs provides the mindset. He gave us the map. The only question left is, which path are you going to follow?
All right, let's dive in. Today, we're opening up the Investor's Toolkit, and our guide is the legendary Barton Biggs. We're going to break down his wisdom into some really powerful mental models, tools that can help you conquer what is probably the single biggest challenge in investing, your own psychology. Let's get to it. You know, this quote from Gustave Le Bon gets right to the heart of it. The real problem for any investor isn't just about picking stocks. It's about fighting that deep, primal pull of the crowd. Biggs believed that understanding this force is step 1, because in the market, the crowd gets swept up by one incredibly powerful, contagious idea: getting rich quick. Okay, so here's the game plan. We're going to build a toolkit with 5 essential ideas from Biggs. First, we'll look at the problem, the madness of crowds. Then we'll get into 4 powerful solutions: the contrarian's compass, the Soros feedback loop, the investor's mindset, and finally, my favorite, taming Mr. Market.
So first up, let's tackle this fundamental challenge of market psychology, this bizarre tendency for even the smartest people to just lose their minds and join the herd. And this right here gets right down to our basic human wiring. Biggs was really into thinkers like Le Bon and Trotter, who saw us as these fundamentally social creatures.
Trotter actually called our herd instinct a primary one. He said that physical and intellectual loneliness will be a real terror. I mean, think about it. That's why it feels so much safer to run off a financial cliff with everybody else than to stand alone, even when you can see the drop coming. That's a powerful force we're up against.
So how in the world do you fight an instinct that powerful? Well, our first tool in the toolkit is what we're calling the contrarian's compass. This is basically the philosophy of intentionally investing against the crowd, against its fads, its fears, and its wild extremes.
But being contrarian isn't a one-size-fits-all deal. Biggs points out two really different types. Over on the left, you've got the contrarian trader, like Fred Kelly. His enemy is the public, the little guy. His whole motto is to do what feels difficult, lonely, even a bit illogical. Then, on the right, you've got the contrarian investor, like David Dreaman. His targets are the so-called experts. He buys solid, totally unloved companies with low price-to-earnings ratios, which is basically a measure of how expensive a stock is, betting that the professional crowd is just plain wrong.
And this image, man, it just says it all, doesn't it? This is the emotional cost. Being a real contrarian, no matter which style you pick, is tough. It is psychologically brutal. It means you have to endure that intellectual loneliness that Trotter talked about. You are actively choosing to be this hedgehog, walking your own solitary path while the rest of the herd is thundering off in the other direction.
And that's really the heart of it, right? This is the contrarian's creed. It's about having the guts to take that road less traveled because you believe it's going to make all the difference. But what if you could do more than just go against the herd? What if you could actually understand the engine that drives the herd? Well, that brings us to our next tool.
Okay, so now we're going to level up a bit. If being a contrarian is about betting against the crowd, George Soros' theory of reflexivity is about understanding the engine that drives that crowd in the first place. It's a really advanced tool for seeing how markets don't just reflect reality, they actually help create it. Okay, so here's the deal. Traditional thinking says the market is like a passive mirror, right? It just reflects a company's fundamental reality. Soros comes along and says, nope, that's all wrong. The market is an active participant in the game. There's this constant two-way feedback loop. What investors think about a stock can actually change the fundamentals of the company, which then reinforces what investors were thinking in the first place. See, the market doesn't just predict the future, it helps create it. Let me walk you through how this actually plays out. It all starts with a bias. Let's say investors get way too excited about some new tech company. Their excitement drives the stock price up. Now, because the stock is so high, the company can easily raise more cash or buy other companies, which makes their business look even better. This just validates the initial excitement, and boom, you've got a self-reinforcing cycle. But of course, this can't go on forever. At some point, the gap between the hype and reality gets too big, the feedback loop reverses, and that boom turns into a spectacular bust. Okay, so we've been looking at tools to understand the market out there. But now, we're going to turn inward. Because maybe the most important tool of all isn't a theory or a strategy, but the one you use on yourself. This is all about the internal psychology, the mindset, the temperament of a truly great investor. I love this quote from Walter Bagehot. It's so counterintuitive, isn't it? Biggins was a huge believer that this constant need we have to do something, to be busy, is actually a massive handicap in investing. He said that all that compulsive reading and frantic activity doesn't lead to better decisions. It just makes us more confident about our mistakes. The best insights, he thought, come from just having unstructured leisure thinking time, lying in the sun and just letting your mind work. So if it's not about being busy 24/7, then what is it about? Well, Biggs has this incredible analogy. He says the truly great investors, they're not just number crunchers. They have this almost magical, intuitive feel for the market. They are, in a way, market horse whisperers. So what does a market whisperer look like? Well, they've got what Winston Churchill called a seeing eye, this deep gut instinct that lets them cut through all the noise. They don't just analyze the market, they kind of understand it, and they even love it for the wild, dangerous beast that it is. And Biggs just completely throws out that whole idea that guys like Buffett or Soros are just lucky, that they won some cosmic coin flipping contest. No way. He was convinced they have a special gift, one that's been sharpened by an intense, lifelong obsession with their craft. All right, this brings us to our final tool, and honestly, this might be the most powerful and practical one of the whole bunch. It's from Benjamin Graham, and it's this brilliant master metaphor
for thinking about the market in a way that lets you control your emotions by taking advantage of everyone else's. So I want you to meet your new business partner. His name is Mr. Market. And, well, he's a manic-depressive. Some days he's going to show up at your door totally giddy, euphoric, just screaming about how amazing the future is, and he'll offer to buy your stocks for crazy high prices. What's Graham's advice? Easy. Sell him your shares. Take his money. But on other days, Mr. Market will be a total wreck. Miserable, depressed, convinced the world is ending. He wants out, and he'll sell you his stocks for pennies on the dollar. His despair is your golden opportunity. You buy. The whole strategy is to use his emotional roller coaster to your advantage instead of letting it infect you. And this, right here, is the perfect way to think about it all. Warren Buffett's famous line reminds us that this is a game. Your manic-depressive partner, Mr. Market, is sitting at the poker table every single day, and his behavior is predictably irrational. The key is to make sure you're not the patsy at the table. And there you have it. That's the toolkit. You start by seeing the madness of the crowd. You defend yourself with the contrarian's compass, steering clear of the herd. You get an edge by understanding the Soros feedback loop, the very engine that drives that herd. But none of that matters without the right investor's mindset, that inner horse whisperer. And you put it all into action by treating the market as your emotional partner, Mr. Market. He's at the table waiting. The only question is, are you ready to play?
Let's take a trip back in time to the late 1980s. Imagine you have more money than you know what to do with. The biggest problem isn't making more, it's just trying to keep it. We're going to follow legendary market guru Barton Biggs as he tries to solve this exact puzzle. And what he finds out about art, jewelry, and straight-up survival, well, it might just change how you think about value itself.
So this whole story kicks off with a challenge from a very rich, elegant man. And listen to this objective. He wants to grow his family's fortune by 4% above inflation every single year. That means doubling the family's real spending power every 18 years. This isn't just about getting richer. This is a quest for a kind of financial immortality.
So, that's the big question, isn't it? When you've got it all, where do you put your money for the really long haul? What assets can survive not just a stock market crash, but, what if the whole system goes sideways? That's the puzzle we're trying to piece together here.
And this client, he was not messing around. He just hits Biggs with his rapid-fire list of questions. Is art better than real estate? Is venture capital worth the crazy risk? Is gold really a good insurance policy? What's the hidden cost of playing it safe? He was basically asking, what does value even mean when you're playing for keeps?
Now, to get some real answers, Biggs knew he couldn't just rely on gut feelings. No way. He needed a map of the entire investment world. So he went digging, deep into his firm's data, charting out the returns for every major asset class he could get his hands on.
Okay, so this is that map. This table gives us a stark, numbers-driven look at how everything from stocks to bonds to gold performed after World War II. Let's use this as our guide as we start to unpack this very, very rich man's problem.
Wow. Okay, right off the bat, one number just jumps off the page, venture capital, with a staggering 19% average annual return. It just blows everything else away. So, problem solved, right? Just dump everything in VC and we're done here?
Well, hang on a second. This is the classic investing lesson, isn't it? There's no free lunch. Sure, venture capital offered these incredible returns, but it also came with the absolute worst scores for volatility. We're talking wild, gut-wrenching price swings, and liquidity, meaning you can't easily get your cash out when you need it. It's a thrill ride for sure, but it's no safe harbor for a family dynasty.
Okay, so what about art? That was one of the client's big questions. And according to the data here, art pulled in a very solid 9% a year. That's way better than inflation and even beats safe government bonds. On paper, it looks like a masterpiece of an investment.
Yeah, but here's the thing about numbers. They're clean, they're neat, but they don't always tell you what's really going on. Biggs had this hunch that behind these tidy percentages was a much, much messier human story.
So he decides to go digging. He dives headfirst into the art market of the 1980s. And what he finds? It's not really about investing at all. It's this incredible story about human psychology, about ego, status, and what happens during a full-blown speculative mania. To understand just how crazy things were, get this number in your head.
Just a few days after the huge Black Monday stock market crash in 1987, a Van Gogh painting sells for a mind-blowing $54 million. The entire financial world is in a total panic, but in the art world, the party was just getting started.
But here's the twist. While the market was going absolutely bananas, serious academic researchers were looking at centuries of data and coming to the exact opposite conclusion. They were arguing that, historically, art is actually a pretty poor investment, driven by nothing more than the fickle winds of fashion. So you've got this huge clash between market euphoria and cold, hard research.
And you know what? History totally backs up the academics. Just look at the market for British portraits. It was a total roller coaster. Prices would explode when, say, new American millionaires wanted to buy themselves some instant ancestry, then totally collapse when taste changed. We're talking about paintings selling for just 5% of what they were worth a couple decades earlier. Ouch. So what was fueling the 80s bubble? It was this perfect storm of human behavior. You had so-called power collectors buying for bragging rights, an unbelievable buying spree out of Japan that soaked up 40% of all Impressionist art, and dealers who, as Biggs put it, were fattening the innocents for the slaughter. Pretty sharp words. This wasn't investing. It was a bubble. Okay, so you have that speculative madness on one side. Now, let's flip the coin completely. Biggs uncovered another story, one that reveals a totally different kind of value. One born not from hype, but from pure, desperate survival. This quote is from the head of a rich Hong Kong family who had lived through absolute chaos. And for him, the single best store of value, the ultimate disaster hedge, wasn't stocks, it wasn't bonds, it wasn't even gold. It was quality jewelry, better than gold. See, his belief was forged in crisis. When the Japanese occupied Hong Kong back in 1941, his family's entire financial world vanished overnight. Bank accounts? Frozen. Rent payments? Poof, gone. They went from wealthy to literally starving. And the only thing that saved them, the only thing they could trade for food, was their family's jewelry.
And why did jewelry work when nothing else did? The reason is so simple. It's totally human. The occupying soldiers and their girlfriends, they wanted it. It was beautiful, you could carry it, it was a universal symbol of wealth. In that environment, as the man said, gold bars just weren't pretty enough.
Now, this is a really key point Biggs makes. He is not talking about loose diamonds. That whole diamonds are forever thing, that's just marketing. They're not a great investment. He's talking about high-quality, antique, collectible jewelry, signed pieces that are basically little works of art you can wear. That is the real storehouse of value.
All right, so after all this, the art mania on one side, the survival story on the other, what was the final takeaway? What did Barton Biggs tell his wealthy client? Let's see the final verdict.
So here it is. This is the actual asset allocation model from his firm in 1990. And look, just look at what's sitting squarely in the overvalued, the sell column, right there, modern art and impressionist art. After seeing the mania up close, his conclusion was crystal clear. Get out now.
And now, let's check out the undervalued, the buy column. And yup, there it is, clear as day, antique jewelry. This is the whole story in a nutshell. One asset, art, was a speculative bubble just waiting to pop. The other, jewelry, was a timeless, tangible store of value, especially when things go wrong.
So what does this all boil down to? What's the big lesson here? It's this. The data, the charts, the spreadsheets, they're absolutely crucial. They tell you what happened, but it's the human stories of greed and fear and status and survival that tell you why, and real wisdom in the market comes from understanding both sides of that coin.
And that leaves us, and you, with one final question to think about. When you look at any investment, are you just seeing its price, which might just be driven by a temporary craze? Or are you looking deeper to understand its true enduring purpose? Something to think about.
You know, trying to navigate the financial markets, it can feel like you're lost at sea, right? Confusing, maybe a little scary. But what if we had a map from a guide who'd seen it all before? Well, today we're going to do just that by diving into the timeless wisdom of a true investing legend, Barton Biggs. His insights from decades ago are frankly more relevant today than ever. So let's get into it. Right out of the gate, Biggs doesn't pull any punches. I mean, listen to this. He paints this incredibly stark, dramatic picture. Investing isn't some pleasure cruise.
No, it's a high-stakes voyage on the Titanic, and the ocean is just loaded with dangers. But here's the kicker. We have to get on that ship if we want to get to a better place. All right, so here's our game plan. We're going to take a trip through about 20 years of Barton Biggs' best thinking. We'll kick things off with how to survive on that Titanic, then we'll listen to a little story about an old turkey, figure out why you should be skeptical of the crowd, then feel what it's like to be in the middle of a full-blown mania, and of course, see what happens when it all comes crashing down.
Okay, let's travel back in time. The year is 1980, March to be exact. And let me tell you, things are a mess. The world is dealing with this ugly thing called stagflation. That's a nasty mix of high inflation and basically zero growth. We've got oil crises, people are feeling pretty hopeless about the economy. Yeah, it really feels like the ship is taking on water before it's even left the dock. And this is where we get to the heart of Biggs's whole philosophy. Think about it. When inflation is just chewing up the value of your money, hiding out in cash, well, that's not a safe harbor at all. It's actually a guaranteed way to lose. Your money's buying power just vanishes over time. So what he's saying is, you don't really have a choice. You have to take some calculated risks. You have to get on the ship. Okay, so if you have to get on this dangerous ship, how in the world do you survive? Biggs' answer is, well, it's just brilliant in its simplicity. He says, look, if you're going to sail through an ocean full of icebergs, why not go first class? Invest in the absolute best, the highest quality companies out there. The strongest swimmers, as he called them. Why? Because they've got the best shot at surviving no matter what disaster comes their way. All right, fast forward just a couple of years to October 1982. The storm clouds have cleared. A brand new, massive bull market is just getting started. And now investors are facing a totally different problem. That nagging, overwhelming temptation to sell way too early. And to really hammer this point home, Biggs tells this amazing story from an old book about trading. It's a classic. So picture this. You've got Elmer, this young, energetic trader. He's just made a quick buck, and he's dying to cash in. And then you've got Mr. Partridge, a wise old speculator who's so quiet and steady that everyone just calls him the old turkey. So Elmer, all excited, runs up to the old turkey and says, "You gotta sell, lock in that 7-point profit." But the old man, he just calmly shakes his head and delivers this absolute gem of a line. See, he wasn't thinking about a little 7-point gain. Nope, he was playing a much bigger game. And this is what he was talking about. This is so key. Losing your position isn't just selling one stock. It's about completely getting off the train. It's about exiting the market's huge, primary, long-term upward trend and then being stuck on the platform just watching as that train barrels down the track for years and years without you. And that's it. That was the old turkey's entire reasoning. He just kept repeating it, almost like a mantra, because he knew something profound. The hardest thing to do in a bull market, and usually the most profitable thing, is to just sit on your hands. Just sit tight, tune out all the noise, and whatever you do, don't lose your position. Okay, let's jump to 1984. The bull market is definitely in full swing now. But Biggs points out a new kind of iceberg to watch out for, the constant, deafening drumbeat of conventional wisdom, especially the stuff you hear from the media. And just look at the difference here. It's night and day. On one side, you've got all these gloomy headlines from the press. Everyone's convinced the party's over. But on the other side, you have Biggs. He saw things completely differently. He basically said that the intelligentsia, the expert class, they just have this built-in bias for being bearish. They were totally missing the real story, which he thought was profoundly bullish. And guess what? He was absolutely right. All right, let's hit the fast forward button and land in July 1997. Whoa, we are now deep in the mania of the dot-com bubble, and this is where it gets personal. Biggs gives us this incredible day-by-day diary of what it actually feels like to be the same person in the room when everyone else has gone completely crazy. I mean, check out this 1 week. It's just a constant assault from every direction. On Monday, some random guy at Grand Central Station starts preaching to him about the new era. On Tuesday, his own young colleagues are making fun of him for wanting to hold cash. All week, clients are pressuring him to just buy the S&P 500, which is insanely overvalued. And get this, even his older buddies who are also bears, they're too terrified to actually sell anything. The psychological pressure to just give in and join the party must have been absolutely immense. And wow, this quote from one of his younger colleagues, it just hits you right between the eyes. It explains everything. Because you see,
In a bubble, being the rational one isn't just a lonely job, it's a massive career risk. For these younger guys, if they underperformed this market that was going straight up, they could literally lose their jobs. It just perfectly captures that brutal conflict between being prudent and, professional survival. So, you gotta ask, how does a party like this finally end? Well, by 1999, 2000, Biggs is breaking down the mechanics of how these things top out, how that inevitable turn finally happens. He titles this section after an old Japanese proverb, even monkeys fall from trees, which means, hey, even the absolute best climbers, they all fall eventually. Now, to really get what happens next, you have to understand this idea of virtuous and vicious circles. Biggs explained that markets get caught in these self-reinforcing loops. So during a boom, right, prices go up, people feel richer, they get more confident, and they buy more. That's a virtuous circle, pushing things higher and higher. But, and this is the scary part, it works just as powerfully on the way down. A bust starts, which forces selling, driving prices even lower, which creates panic, and you guessed it, more selling. A vicious circle. So why don't these trends just go on forever? Why do they always break? Well, Biggs brings in a quote from the historian Barbara Tuchman that just nails it. You can't draw a neat line on a chart and expect it to continue forever, because the human element, our emotions, our fear, our greed, it always messes things up. Markets aren't science, they're not physics, they're pure psychology. So, what gave Biggs the guts to stand his ground when everyone was calling him crazy? Simple. He'd seen this movie before. As he's watching the NASDAQ go vertical in '99, it was like deja vu. He saw an almost perfect parallel to another crazy bubble from back in the early '70s, the mania for this small group of elite growth stocks they called the Nifty 50. And this chart, this perfectly illustrates what was going on in his head. You can see how those Nifty 50 stocks just shot up, leaving everything else in the dust, until 1973. And then, bam, they just completely collapsed. This chart was basically his historical roadmap for what was about to happen. I mean, the similarities were just uncanny. You couldn't ignore them. In the 70s and in 2000, you had a tiny group of it's different this time growth stocks that everyone had to own. In both periods, value investing was basically a joke. People were pulling their money out of value funds left and right. Biggs saw history rhyming, and he had a pretty good idea how this song was going to end. So, after this whole journey, what can we take away from all this? What's the Barton Biggs playbook? Well, it really boils down to a few core rules. First, investing is a dangerous trip, so own quality to survive. Second, when you're in a real bull market, find the courage to actually stay in it. Third, be super skeptical of what everyone else is saying, especially when things get extreme. And finally, never forget that human psychology is the one true constant. And because of that, no trend, I don't care how powerful it seems, no trend lasts forever. And that really leaves us with one final big question to ask ourselves. When you look at the market today, with all its noise, all its competing stories, all the talk of new eras, it's worth taking a second to ask, whose wisdom are you following? Are you listening to the screaming of the crowd, the confident predictions of the pundits? Or are you listening to the quiet, simple, timeless wisdom of the old turkey? All right, let's dive into one of the all-time great investment stories. It's an absolute masterclass in contrarian thinking, and it's set against the backdrop of a city that was utterly convinced it was staring into the abyss. This is the story of how the legendary investor Barton Biggs made a fortune by betting on Hong Kong when literally everyone else was running for the exits. Okay, so picture this. The year is 1983. You're out on this gorgeous powerboat in the middle of Hong Kong's harbor. The owner, a super successful Chinese broker, turns to you and says, that. And you know what? He is dead serious. That single question just says it all, doesn't it? It perfectly captures the sheer, unadulterated panic that had gripped the entire city. The belief was that the party was over, and the only smart move left was to get out. And here's why people were so terrified. The Hong Kong stock market had been completely and utterly decimated. It had plunged 74% from its peak just a couple of years before. I mean, this wasn't just a correction or a dip. This was a total collapse of confidence, a complete wipeout of wealth that was fueling this citywide fear. So what was going on? Well, the city's entire future was hanging in the balance. It was all being decided in these super tense negotiations between Britain and China over the 1997 handover. But the thing is, the talks were going terribly. The prospect of total Chinese control was seen as an absolute disaster, and the city was just spiraling into this massive crisis of faith.
And this really gets us to the heart of the story. In a market that's just consumed by fear, where everyone, and I mean everyone, is screaming sell at any price, what does it take to see things differently? What kind of proof do you need to step in and start buying when the rest of the world is telling you you've lost your mind?
So, to really get why this investment was so incredibly bold, you first have to understand the scale of the fear. And trust me, it wasn't just numbers on a stock ticker, it was everywhere. You could feel it on every street corner.
I mean, what's so fascinating here is just how real and tangible the panic became. The currency cratered. People were panic buying food, emptying out grocery stores. And get this detail. This one is just amazing. Apartments above the 5th floor became impossible to rent. Why? Because people were convinced that the new Chinese administration wouldn't be able to keep the elevators running. That is a very specific and very profound level of fear.
Yeah, this wasn't just a financial crisis anymore. It was a psychological one. A really prominent local figure, Dr. L.K. Ding, actually said the city seemed headed for collective suicide. Think about that. The very people who had built one of the most dynamic economies on Earth had completely given up on its future.
But, and this is a huge but, while everyone was reacting to the scary headlines and all the emotion, Barton Biggs was doing something else entirely. He was looking at the numbers. He was doing the cold, hard math. And you know what? The numbers were telling a completely different story. Okay, this is really the whole ballgame right here. The best companies in Hong Kong were trading for just 5 or 6 times what they earned in a year, and they were paying you a 7% dividend just to own their stock. The entire market was selling at a 33% discount to its book value. That means you could theoretically buy every company, sell off all their stuff, and make a massive profit. I mean, to put that in perspective, the S&P 500 only trades at its book value during its absolute worst moments. Hong Kong was on a historic, once-in-a-generation fire sale.
And this chart, this is the picture of that moment. This is the market hitting absolute rock bottom. It's what people in finance call the point of maximum pessimism. It's that moment where every last person who wanted to sell has finally thrown in the towel. Now, for most people, this chart is terrifying. For a true contrarian like Barton Biggs, this wasn't a stop sign. It was a giant, flashing green light that screamed buy. And here's the craziest part. While the market was having this total meltdown over politics, the actual on-the-ground economy was humming along just fine. Exports were soaring, unemployment was going down, and the economy was growing at over 6%. And here's the real kicker. China, the very country everyone was terrified of, wasn't just using Hong Kong as its gateway to the world, it was also a massive investor in Hong Kong.
So Biggs summed up his whole thesis with this simple, powerful line. You know the old investor motto, buy low, sell high. But he added a crucial twist. He was betting that, despite all the fear, this wasn't going to be a repeat of Shanghai in 1949, when the communists took over and the city basically went dark for decades. No, he was betting on resilience. Okay, let's fast forward 5 years to 1988. Biggs's bet had paid off spectacularly. But now the story was evolving. It was changing from a simple buy it cheap kind of play into a much deeper, more profound idea about the entire future of Hong Kong. I mean, the comeback was staggering. By 1987, the economy was posting double-digit growth. That insane panic from '83 felt like a distant bad dream. And by '88, a totally new way of thinking about the 1997 handover was starting to catch on with the smartest investors.
This slide just lays out the incredible change in thinking perfectly. Back in '83, the consensus was that Hong Kong was a doomed city, a political liability. By '88, the new theory was that, wait a minute, Hong Kong is actually a massive strategic asset for China. It's their indispensable economic gateway. The handover in 1997 wasn't the end. It might actually be a huge positive.
And this was the policy that made the whole thing possible. It was Deng Xiaoping's brilliant idea of one country, two systems. It was just a super pragmatic solution that basically promised to let Hong Kong's capitalist engine keep on roaring even after the handover. China needed a thriving Hong Kong, you see, both as a role model and as a financial hub for its own huge development plans.
But as the 1990s began, investing in the whole China story meant you had to understand risks that went way beyond PE ratios. Now, you had to understand the very nature of power in China. This quote, wow, it's from a book called The New Emperors, and it gets right to the heart of it. Chinese history isn't really about political parties. It's about dynasties and emperors. And for an investor, that meant this dynastic risk. The risk of who holds absolute power and what they decide to do with it was everything. So to really get the opportunity, you had to understand the huge shift from one emperor to the next. You had Mao Zedong, whose ideology led to famine and destruction. And then you had Deng Xiaoping, the ultimate pragmatist. He famously said it doesn't matter if a cat is black or white as long as it catches mice. He was all about what works, and he unleashed the power of markets, filled people's rice bowls, and put money in their pockets. That right there, that was the foundation of the modern China investment story. So by the early 90s, the risks were crystal clear. There were two big ones. First, what happens when the emperor, Deng, dies? Is there a power struggle? Does everything get reversed? And second, could China actually manage its red-hot, overheating economy without it all coming crashing down? These were the billion-dollar questions. And this brings us to the final chapter of our story. In 1994, in just over a decade, the market had swung from the absolute depths of despair to the giddy, ridiculous heights of a speculative mania. Barton Biggs wrote this in 1994, and it just perfectly captures the mood. The fear was long gone, and it had been replaced by this just uncritical greed. Everybody, from seasoned pros to guys cold calling on the phone, was pitching the can't-lose China story. The sentiment indicators, as Biggs said, were flashing craziness. And so the ultimate contrarian came full circle. After famously buying fear back in 1983, by 1994 he was getting deeply, deeply worried about all the greed he saw everywhere. He saw that the risk of overheating had shot up and that a painful boom-bust cycle was looking more and more likely. You know, this story is over 30 years old, but its central lesson is absolutely timeless. The story around an investment can be incredibly powerful, but at what point does a compelling growth story, like China's emergence, cross the line into a dangerous mania, where the price has nothing to do with reality anymore? It's a question every single investor still has to ask themselves every single day.
All right, welcome. Today, we've got a really fantastic story for you. It's all about seeing a massive opportunity where pretty much everyone else just saw, well, failure. We're talking about a huge economic bet on a sleeping giant and the one investor who saw it all coming.
So, picture this. It's 1989. An influential investor, a guy named Barton Biggs, comes out with this incredibly bold statement. Now, at the time, this was a wild, almost unthinkable prediction. Why? Because the consensus view on India was, well, the complete opposite.
So let's do this. We're going to travel back in time. We're going to see what Barton Biggs saw on the ground with his own eyes back in the 1980s. What was it that gave him the guts, the conviction, to make such a massive, high-stakes bet on India's future? Okay, first things first, we really need to set the stage here so you can understand just how radical, how out there this idea really was at the time. And look, this wasn't some fringe opinion. We're talking about the view of a Nobel Prize-winning economist here. The experts, the smartest people in the room, they saw a country that was just being crushed by its own policies. A place where the grinding poverty was so depressing that a lot of people, including famous economists like Friedrich Hayek, just avoided visiting altogether. That's how bad the perception was.
So why? Why was everyone so down on India? Well, it all came down to the economic system that had been running the show for decades, what you could call the stagnant socialist model.
You know, ever since its independence, India had basically followed this philosophy, and the core idea was pretty simple. The government knows best, not the market. So, the state had first dibs on everything. It controlled businesses, it set prices, and it used unbelievably high taxes to, at least in their view, make sure everything was fair.
And when I say high taxes, I mean breathtakingly high. The top tax rate for an individual, a staggering 68%. Just let that sink in for a second.
But here's the real kicker. That 68% rate, it wasn't for millionaires. Nope. It kicked in when you started earning just $8,000. Can you imagine? It was a system that pretty much punished any attempt to get ahead or create wealth.
And, The results were exactly what you'd expect. The economy was just stuck in first gear, barely moving. People's incomes weren't growing at all. And if you were an entrepreneur, forget about it. You were completely stifled. The country had this massive brain drain, with its best and brightest leaving for better opportunities somewhere else. It was all thanks to what Barton Biggs perfectly called the dead hand of bureaucracy.
But then, something totally unexpected happened. A new leader comes to power, and he is about to set off what you could only describe as an economic Big Bang.
So after his mother, Prime Minister Indira Gandhi, was assassinated, her son Rajiv took over. But here's the thing. He wasn't your typical lifelong politician, steeped in all that socialist theory. He was a former airline pilot, a practical guy who had seen with his own eyes how all this government interference was just holding his country back.
And bam, in his very first budget in 1985, he just unleashes this classic supply-side shock. One economist literally called it an epoch-making budget for redesigning India. Think about that. He slashed corporate taxes. He raised the income levels for the tax brackets. He dropped that insane top rate from 68 all the way down to 50%. He even got rid of the inheritance tax. It was a complete 180-degree turn from decades of policy.
And the reaction? Oh, it was immediate, and it was explosive. The Indian stock market just soared, from 305 to 350 practically overnight. In fact, the authorities got so freaked out by how fast it was rallying that they actually closed the market for a few days just to try and calm things down. That's how big of a deal this was.
Okay, so that's the setup, right? A few years after all these reforms, our guy, Barton Biggs, he goes to India to see this new reality for himself. And what he found was a country that was right in the middle of a massive, profound transformation.
I mean, the feeling on the ground was just electric. It was way more than just numbers on a page. One of Biggs's colleagues, a guy who had traveled the world, came back from a trip and said this. It just perfectly captures the energy and this huge sense of possibility that was suddenly in the air.
So what Biggs saw was this land of incredible contrasts. I mean, on the one hand, you had the old India, right? The oppressive heat, the constant noise, machinery that looked like it was straight out of the 1930s. But then, right next to it, you had the new India. You had these modern corporate headquarters that were like an oasis of cool tranquility. You had sophisticated professional managers and this teeming entrepreneurial street life. It was a total paradox.
And this right here, this really gets to the core of his whole idea. With an average income of just $320 per person, India was sitting exactly where the Asian tigers, countries like South Korea and Taiwan, had been about 10 or 15 years before their own massive economic explosions. The key phrase here, the crucial point, was that India looked like it was at the ignition point.
But look, this wasn't some blind, overly optimistic bet. Biggs was totally clear-eyed about the challenges. The potential was absolutely enormous, for sure. But the dangers, they were just as big.
So here's kind of how he weighed it all up. The pros were huge, right? A middle class of 150 million people. That's a giant domestic market, a high savings rate of 22%, and his deeply rooted culture of really smart entrepreneurs. But the cons were serious. You had a messy, inefficient democracy, a huge budget deficit, just nightmarish paperwork for everything, and, of course, corruption.
He just captured this tension perfectly with a couple of really great analogies. First, he said India was like a college kid. Big, sprawling, strong, pulsing with energy. It had boundless possibilities. Everyone had great expectations. But the big question was, will the country ever get its act together?
And his second analogy is, I think, even more powerful. He said investing in India back then was like being in Chicago in 1870. Just imagine that. A place of raw, chaotic, explosive growth. A fantastic place to own a piece of the action as long as you didn't get nicked by a stray bullet.
And that really leaves us with this central question of this entire story, doesn't it? For a pioneer investor, when you're standing on that frontier, how do you weigh that boundless potential against the very real risk of getting hit by a stray bullet? How do you make that call? It's the ultimate dilemma.
So, what's it actually like to be the lone voice of reason in a full-blown market mania? Well, we're about to find out. We're going to follow one analyst, Barton Biggs, on his journey right through the heart of one of the biggest economic bubbles in modern history, 1980s Japan.
And here he is. This is our guide. With just this one witty line from back in 1983, Barton Biggs kind of sets the whole tone.
He's sharp, a little sarcastic, and he's just touched down in a country that's right on the verge of a massive economic explosion. His whole mission? To cut through all that hype and figure out what's really going on.
You see, his journey really poses a question that every single investor faces sooner or later. Where exactly is the line between a hot market and a dangerous bubble? I mean, how can you tell when all that optimism has tipped over into straight-up delusion? Well, Biggs's experience in Japan, it gives us a front-row seat to that exact problem.
Okay, so our story kicks off in 1983. Biggs has just wrapped up his first real deep dive into the Japanese economy. I mean, he's met with everyone from CEOs to government officials, and the impression he comes away with, well, it goes completely against what everyone else was saying.
So here's his core idea, his main thesis. While the rest of the world was still popping champagne for Japan's post-war miracle, Biggs saw the party kind of winding down. He basically argued that the era of that supercharged, explosive growth was over. The economy was, in his words, maturing.
And he used this really powerful analogy to get his point across. He pictured England as being in its 60s, a senior citizen. European economies, they were in their mid to late 50s. The United States, maybe 45. And Japan was closing in on 40. It wasn't a teenager anymore. So those years of just wild, explosive growth, he was convinced they were a thing of the past.
Now, this created a real conflict for him. On the one hand, he was genuinely impressed by Japan's companies. He saw business strategies that were, frankly, often better than their American counterparts. But, and this is a big but, there was one huge problem he just couldn't ignore. The stocks looked very expensive.
And the data totally backed up his concern. I mean, look at this. Japanese stocks were trading in nearly 24 times their earnings. That's almost double the U.S. valuation at the time. And their dividend yield, that's the cash they pay back to shareholders, it was just a tiny fraction of what U.S. stocks were offering. For an analyst like Biggs, this was a massive, flashing red flag.
Okay, so let's fast forward 1 year. It's 1984, and the Japanese market is even hotter. But instead of jumping on the bandwagon like everyone else, all this frenzy just makes Biggs double down. His skepticism hardens into a really firm, contrarian stance.
He actually compared the whole atmosphere to the U.S. tech craze at the time. He was seeing all the classic signs of a major market top. The frantic chatter, the wild stories of people getting rich overnight, and his conclusion was just blunt. This is madness, and somebody's going to get hurt.
And then he puts his entire reputation on the line with this incredibly bold call. He said, and I'm quoting here, his guess was that for the next half-decade, the single most important decision for a global investor would be to be underweighted in Japan and overweighted in the United States. I mean, talk about a lone wolf move against a stampeding herd. That's exactly what this was.
There was just one problem with that bold call. For the next 4 years, the market made him look very, very wrong. Japanese stocks just kept soaring. But instead of admitting defeat, Biggs did something pretty fascinating. He pivoted. He developed a new, much more sophisticated theory to try and explain what on earth was going on.
See, he realized that Japan's entire national strategy was going through this massive shift. The old way, the post-war model, was all about being an exporter, and to do that you need a weak yen to keep your goods cheap for everyone else. But the new goal? To become a global investor, using all that immense wealth to buy up assets all over the world. And really, it all came down to the currency. After 40 years of incredible success as an exporter, Japan was basically ready to build what Biggs called a commercial empire. And to do that, you need a strong yen, maybe even an overvalued one. Why? Because that strength would let them go on a global shopping spree, buying up foreign assets at what was essentially a huge discount. Okay, but what about those insane stock prices? To explain that, Biggs turned to the legendary investor John Templeton for an answer. And Templeton's analogy is just perfect. He said, in a bubble, stocks aren't really about financial returns anymore. They're like diamonds. Their value is about status, about showing other people you've got a lot of money. It just perfectly captures the psychology of that moment.
And all of this brings us to the final act. We're now in 1991. The bubble has burst, the music has stopped, and now we get to see the real-world consequences of Japan's commercial empire strategy.
Remember all those late 80s headlines, all the panic about Japan buying America? Well, looking back, Biggs points out the incredible irony. While America was freaking out, it was actually making some of the greatest sales in its entire history.
And man, what a shopping spree it was. We're talking about a who's who of iconic trophy assets being bought up by Japanese investors. Things like Rockefeller Center, CBS Records, Columbia Pictures, Pebble Beach, the list goes on. I mean, they had impeccable tastes, you have to give them that. But their timing? It could not have been worse. They were buying at the absolute tippy top of the peak.
Yeah, let's just take Pebble Beach as an example. A Japanese developer paid a reported $800 million for it. Now, to put that in perspective, even experts at the time said that price was $200 million too high. It was just a staggering sum that perfectly symbolized the excess of the whole era.
This is what happens when a bubble finally pops. It's a concept called asset deflation. And Biggs gives this incredible concrete example. So a Japanese investor buys a prime New York City office building. To break even, they needed to lease it for $70 per square foot, okay? Well, by 1991, the market rate had crashed to $28 per square foot. And get this, their operating costs were $30. The entire investment was a complete and total cash flow disaster.
But here's the really amazing part. This wasn't some uniquely Japanese story. Not at all. In fact, it's a cycle that just keeps repeating. The financial historian Robert Sobel actually documented how, for centuries, foreign investors have had this tendency to buy U.S. assets at the very top of the market, only to sell them back to the locals at the bottom.
So, what's the final takeaway from this whole saga? Well, Biggs's conclusion was pretty simple. The locals are just much better judges of their own economy and values. The home team has an advantage. They understand the nuances in a way that an overseas investor, who might be caught up in all the hype, often just can't.
And all of this leaves us with a pretty provocative question, doesn't it? Barton Biggs' journey is this powerful reminder that when a story seems a little too good to be true, when the whole world is celebrating some kind of economic miracle, maybe that's the exact moment you should start investigating and asking the really tough questions.
Today, we're going to do something a little different. We're going to flip through the pages of an investor's journal and step right into their shoes. We're going to travel through 3 really distinct moments in time. And look, this isn't just about the numbers on a spreadsheet. It's about getting to the heart of the powerful human stories. You know, the greed, the hope, the fear that really, truly shape our financial world. All right, let's dive in.
And that feeling right there, that's what drives this whole journey. It's that incredible, thrilling moment of discovery, that constant search for the next big thing. The one country that's right on the edge of a huge breakthrough. It's a hunt that can lead to some absolutely incredible gains, but, as we're about to see, it can also lead you straight into some unexpected dangers.
So our journal is basically split into 3 core entries. First, we'll watch a spectacular bubble inflate and then pop in the Middle East. Then, we're going to feel that historic optimism as a wall crumbles in Europe. And finally, we'll join the search for a new opportunity only to see the whole story get completely spoiled by politics.
Okay, so our first stop takes us to Kuwait in the 1980s. The oil boom had left the nation totally flush with cash, which, well, it set the stage for one of history's absolute wildest speculative manias.
You know, what's so fascinating is that Kuwait didn't just have one stock market. Nope. Alongside the official one, the real action, the crazy stuff, was happening on this informal curb exchange for what they called Gulf shares. I mean, this was the Wild West. Getting returns of 100 to 200% a month? That wasn't even unheard of.
And all of that mania inflated the combined market to a just staggering valuation of $90 billion by early 1982. Now, to put that into perspective for you, at that exact moment, it was the 4th largest stock market on the entire planet. Yep, bigger than most of Europe's.
So how in the world did it get so big so fast? Well, the engine behind all of this was this incredibly leveraged system. Just imagine buying a stock not with cash, but with a post-dated check for, let's say, double the current price, due in a year. You're basically just betting you can flip that stock for a profit before the check ever has to be cashed. Then the seller takes your check, sells it to someone else at a discount for quick cash, and plows that money right back into the market. It was a daisy chain built on pure, uncut speculation.
This whole thing just consumed the entire society. You had people quitting their jobs to play the market full-time. And this one anecdote, it just perfectly captures the madness. A former clerk, who now owned his own private jet, had personally written $10 billion in these post-dated checks. It just goes to show you how completely disconnected from reality things had become. And then, well, the music stopped. When the market finally turned, the whole system just collapsed in on itself. That $90 billion market, it just vaporized. It fell by 98%, all the way down to less than $2 billion. An almost total, complete wipeout. Look, this wasn't just some bad bear market, this was a historic event. A 98% drop puts the Kuwaiti crash right up there with those infamous bubbles you read about, like the Mississippi Scheme of 1721. It was a total textbook story of human psychology and speculative excess.
All right, let's turn the page. Our next journal entry jumps us to November 1989. The Berlin Wall is falling, and for an investor, this isn't a story of mania. No, this is a story of a once-in-a-generational opportunity.
You can just feel the conviction in those words, can't you? This wasn't a bet on a chart or some earnings report. This was a bet on history, a bet on freedom, a bet on people power. The whole thesis was simple. The end of the Cold War was about to unlock this immense economic potential.
The core logic here was actually pretty simple. Literally overnight, West Germany gained access to a highly educated, highly skilled workforce right next door, for just a fraction of the cost. And think about it. The 16 million people of East Germany would want cars, VCRs, a better life, creating a massive new consumer market. It was like discovering an emerging market right in the heart of Europe.
But here's the thing. This was not an easy or obvious call at the time. The German market had actually been pretty weak. A lot of people were pessimistic, worried about inflation and strikes. So this was a true contrarian bet, a decision to look right past all that short-term uncertainty to the promise of a totally transformed future. And now for our final entry. The year is 1993. The huge success of turnaround stories like post-war Germany has investors scouring the entire globe. The hunt is officially on for the next big thing, the next undiscovered gem. This was the question on literally everyone's mind. The real thrill, as our source puts it, isn't in recognizing a winner that everybody already knows about. No, the real thrill is in the discovery. And so, the investor's eyes turned back to the Middle East. I mean, on paper, Egypt looked perfect. It had a huge population, a stock market that had basically been asleep for years, and these big, inefficient companies that were trading for pennies on the dollar. It had all the classic ingredients of a future emerging market superstar. The economic story was absolutely compelling.
But then, the story took a sharp, dark turn. The economic potential was all there, but it was about to be completely overwhelmed by a totally different kind of force, political risk.
And there it is, one sentence that just changes everything. That really promising economic narrative was completely derailed by a factor that had nothing to do with economics. So, what exactly was this risk that spoiled the whole story?
Now, the source is very specific here. It's not talking about broad religious movements. It's talking about a particular extremist element whose stated goal was to overthrow existing governments and to do it through violence. And that distinction is absolutely crucial to understanding the specific risk that investors were facing.
This risk, it wasn't theoretical. It was real and it was escalating. The source reports a clear pattern of targeted violence across the whole region. In Egypt, the vital tourism industry was under direct attack. Foreign businessmen were being targeted. For an investor, this level of instability made the country's economic potential completely irrelevant. The political story had become the only story that mattered.
So, a bubble of pure mania, a revolution of incredible hope, and a promising story just spoiled by risk. What does this journal really teach us in the end?
And this, right here, is the crucial point. To truly understand markets, you have to read the world's stories, not just its balance sheets. The Kuwaiti bubble, that was a story of human greed. The German bull market, that was a story of human freedom. And the missed opportunity in Egypt, that was a story of political peril.
Which leaves us with a final question to chew on. These same forces, mania, revolution, risk, they're at play right now, all around us. The lesson from this journal is to look beyond the numbers and really ask yourself, what are the powerful narratives shaping our world today? Because those are the stories that will ultimately determine the next big winner and the next big risk.
All right, let's say you're an investor, and the year is 1990. The world is changing like crazy, faster than ever before. So where do you place your bets? Today, we're diving into one of the boldest economic plays of that time, the high-stakes gamble on Latin America. Think about it. The Berlin Wall had just come down. The old rules of the Cold War, gone. There was this feeling in the air that, anything was possible. And when anything's possible, that means there are new opportunities. So with that old East-West showdown fading away, investors all over the globe were pulling out their maps. They were hungry, looking for the next big thing, the next place that was just going to explode with growth.
Now, most of the smart money was looking at two places: the brand new markets in Eastern Europe or the Asian tigers, which were absolutely roaring. But there was another story unfolding, a much messier, much riskier, and maybe, just maybe, a much more profitable story in a part of the world most people had written off for dead. And that, right there, was the great Latin American gamble. For decades, I mean, if you thought of the region, you thought of instability, debt, chaos. But something was starting to change. You could hear these whispers of a historic turnaround that could make people an absolute fortune if they were brave enough to listen. And the early signs? They were electrifying. In 1990 alone, Mexico's stock market shot up 53%. Chile was up 15%. People started talking about four-baggers, Wall Street slang for an investment that quadruples. These are the kind of returns that don't just make you money, they make careers. So, what was going on? What was fueling this fire? Well, it was a massive, radical shift in how these countries thought about their economies. Governments were basically tearing up the old rulebook, the state-controlled model, and they were embracing a bold new playbook: deregulation, privatization, and just throwing their doors open to the world. But, and this is a huge but, Latin America was dealing with a deep, historic problem that the Asian tigers didn't really have: just staggering inequality. I mean, look at this. In Asia's boom economies, the richest 20% were about 9 times richer than the poorest. In Latin America, that gap was more than double. And if you thought that was bad, just look at Brazil. It was on another level. The richest slice of the population had 33 times more income than the poorest. Now, this isn't just a number on a page. It's a recipe for total political instability. You see, this huge gap between the rich and the poor created what Harvard economist Jeffrey Sachs called the populist cycle. A politician comes along, sees all the social unrest, and promises everybody the moon. How? With quick fixes like printing tons of money or massive government spending. And for a little while, things feel great. But it always ended in the exact same disaster: crazy inflation, economic collapse, and even more chaos. This new free market playbook was a bet that they could finally, for once, break that cycle. All right, so leading the charge was Mexico. It was becoming the poster child, the investment dream for this whole new era of reform. You have to understand, when President Carlos Salinas took office in 1988, Mexico was on the absolute brink. As he said himself, we could have lost Mexico. Inflation was screaming towards 200%. 1 in 5 people were out of work, and you could feel this tension in the air, like a new revolution was about to boil over. Salinas didn't just tinker. He went on a full-blown attack. He used the army to arrest a notoriously powerful and corrupt union boss. He started selling off huge state-owned companies. He renegotiated a mountain of foreign debt. He slashed regulations, and he cut taxes. It was like economic shock therapy, and it happened with breathtaking speed. He had this famous line, "No more siestas." It perfectly captured this new, relentless drive to modernize the country. And the results? They were immediate, and they were stunning. Inflation just plummeted from that terrifying 200% all the way down to 16%. The star pupil was absolutely delivering. So, if Mexico was the star pupil, Argentina was the magician. Its turnaround was so fast, so dramatic, it almost didn't feel real. It felt like a magic trick.
Someone watching at the time put it perfectly. If Mexico is an investment dream, then Argentina is a magic show, held together by threads of gossamer. It was a beautiful thing to watch, but everyone knew that just like a thread of gossamer, it could snap at any second.
The magician's name was Domingo Cavallo, the finance minister. And his masterstroke, his big trick, was pegging the Argentine peso to the US dollar. He basically made a promise to the world that every single peso was backed by a real US dollar. This move created instant trust. It ended hyperinflation literally overnight, and it kicked the economy into high gear, generating 7% real growth. But here was the terrifying catch. The entire magic show depended on that dollar peg. It was the central pillar. But as costs in Argentina started to rise faster than in the US, their currency got more and more overvalued. Still, they couldn't break the peg. It wasn't an option, because if they did, it wouldn't be a gentle 10% correction, it would be a 50% collapse, and poof, the country would be right back where it started.
And that brings us to the biggest gamble of them all, Brazil, the sleeping giant of South America. If this giant ever woke up, the rewards would be absolutely immense. But back in 1990, it was still trapped in a total nightmare.
I mean, just look at these numbers. While its neighbors were finally starting to get things under control, Brazil was spiraling deeper and deeper into hyperinflation. We're talking nearly 3,000% in 1990. Can you imagine? Prices weren't just doubling every year, they were doubling every few weeks. It was pure economic chaos. Now, because of all that chaos, Brazilian companies were on sale for pennies on the dollar. The stock market was trading at a price-to-earnings ratio of just 3. What that means is you could theoretically buy up a company's entire future for just 3 years' worth of its profits. Compare that to Mexico, which was trading at over 10. For anyone with guts, this was the ultimate high-risk, high-reward bet. So, you've got these 3 incredible, distinct stories, right? The disciplined star pupil, the high-wire magic show, and the sleeping giant. But this wasn't just some regional drama. Why did this Latin American gamble matter for the entire world? These 2 maps pretty much tell the whole story. On the left, you see the world's economy in the late 80s. You can see it's totally dominated by the old powers. But then look at the map on the right. That's the world by population. That is where the people are. That's where the future markets were. And right in the middle of it, you see the sleeping giants of Latin America, just waiting for their moment. The potential was just off the charts, but all those deep-seated problems, they hadn't just magically disappeared. This economic revolution would go on to create incredible fortunes, but it would also trigger some absolutely devastating crises. So, that leaves us with the big question to ponder. Looking back from where we are today, with everything we know about the booms and the busts that came after, was the great Latin American gamble really worth it?
All right, welcome. Today we're diving into what it really takes to pull off the seemingly impossible. We're talking about high-stakes strategy, and trust me, we're going to find the lessons in some pretty unexpected places. So let's just start with the big question that's going to frame this whole thing. What is the formula for a miracle? I mean, is there one? Is it all about meticulous planning, raw, gritty determination, or is it just a roll of the dice?
Well, we're going to try and figure that out by looking through 2 completely different lenses. First, we'll follow an investor navigating the absolute economic explosion of East Asia back in the 80s and 90s. And then we're going to pivot to a desperate do-or-die moment in military history.
Our first stop is Singapore, 1983. People were calling it the best managed country in the world. But this story is really about the steep, steep price that sometimes comes with that kind of perfection.
To really get your head around Singapore's success, you just have to look at this number, 9%. For the 15 years leading up to 83, its real GNP growth averaged 9% every single year. That is just a staggering figure for a tiny city-state with basically zero natural resources. So how on earth did they do it?
The answer, really? It starts with one man, Lee Kuan Yew, the architect of modern Singapore. His whole philosophy was brutally simple and pragmatic. As he put it, their survival wasn't guaranteed by anything, really. It was all down to sheer will and hard work. And that mindset shaped literally every policy.
And that will and work philosophy, it translated into a very unique, let's call it a toolkit. It was a wild mix of free market capitalism and incredibly intense social engineering. You had total industrial peace, sure, but that's because strikes just didn't happen. The state regulated everything from the length of a man's hair to who should be having kids, even offering cash incentives based on parents' IQ scores. And the laws were severe. I mean, the penalty for drug possession was death. If a kid was caught with marijuana, their entire family could get kicked out of the country. At the end of the day, Singaporeans traded certain freedoms for incredible prosperity and security.
Okay, now let's jump to our next case and see how this all connects. We're in South Korea, 1988. Another economic miracle, for sure, but this one has a totally different vibe and a pretty serious catch.
I mean, the speed of the change here is just astounding. In only 24 years, South Korea went from being one of the poorest countries on the planet, with a GNP per capita of just $40, to a full-blown industrial powerhouse. They call this transformation the miracle on the Han River.
So what was fueling this engine? Well, for starters, an absolutely relentless work ethic. The average work week was around 52 hours. You combine that with his deeply embedded entrepreneurial spirit, a massive 36% savings rate, and a young, growing workforce, and the country was basically running on pure adrenaline and ambition.
But here's the catch. That miracle definitely came at a price. Just beneath the surface, there was serious labor unrest. Workers were demanding their piece of the pie, protesting conditions that one observer said were straight out of Dickens. Add to that huge income inequality and the ever-present, very real threat from their northern neighbor, and you've got this incredible growth story that's basically balanced on a knife's edge.
All right, our third stop takes us to Thailand in 1990. This was a country that wasn't so much managing a miracle as it was just trying to hang on for the ride.
The atmosphere in Thailand at the time was literally described as Camelot. It felt like this magical kingdom of just frantic, euphoric growth, where it seemed like everybody was getting rich and the good times were never going to end.
And this wasn't just a feeling, you know? The data totally backed it up. For 3 years straight, Thailand was the fastest growing economy in the world, with real economic growth hitting around 10%. It was even outpacing its other high-flying neighbors in the region.
But this kind of gold rush always has side effects, right? The infrastructure just couldn't keep up. Bangkok was choked with pollution, and the traffic was so bad it could take you an hour to go just 3 miles. And a new kind of anxiety started to creep in, captured in this phrase: better to be a nice than a Nick, a newly industrializing and corrupting economy. The Thais were starting to wonder if all this dizzying growth was worth the damage to their quality of life.
So we've seen 3 different models of success. One brutally disciplined, one kind of running on fumes and friction, and one that was just joyfully chaotic. But to understand the absolute purest form of a high-stakes gamble, we have to leave the world of economics behind completely. We have to step onto a battlefield where the only outcome was victory or total annihilation.
We are going to Incheon, Korea in 1950. The situation is beyond dire, and the plan on the table is what many considered to be a 50-to-1 long shot, and that might have been generous.
So you have to picture this: the summer of 1950, and everything, and I mean everything, had gone wrong. A surprise North Korean invasion had just decimated the South Korean and American forces. After weeks of brutal retreat, staggering casualties, they were trapped with their backs to the sea in this tiny defensive box called the Pusan Perimeter. It was literally a stand-or-die moment. They had to break out or the war was lost.
General Douglas MacArthur's big plan was an amphibious landing deep behind enemy lines at the port of Incheon. And the reaction from his commanders? Universal horror. The Navy's top admiral summed it up perfectly. Incheon had 30-foot tides, huge mudflats, a narrow, dangerous channel, massive seawalls. It was, in short, a tactical nightmare.
But MacArthur's counter-argument was just pure strategic genius. He argued that the very unlikeliness of the plan, all those problems, was actually its greatest strength. The enemy would never expect it. He basically told his war council, the very arguments you have made as to the impracticalities involved will tend to ensure me the element of surprise. He staked his entire legacy on this one incredibly audacious move.
And you know what? He was right. The landing on September 15, 1950 achieved absolute total surprise. The North Koreans were so unprepared that the navigation lights in the channel were still on as the American fleet sailed right in. The Marines scaled the walls and took the city before the enemy even really knew what was happening. It was a masterstroke that completely turned the tide of the war.
So, after all that, after looking at disciplined boardrooms and desperate battlefields, what's the big lesson here? What's the thread that connects these 4 snapshots of high-stakes success?
Let's circle all the way back to our original question. We've seen 4 wildly different paths to some pretty extraordinary outcomes. So, is there a single, repeatable formula for a miracle?
The answer seems to be no. There is no single formula. Instead, each of these miracles was a radical strategy that was perfectly, and sometimes brutally, tailored to its specific moment. Singapore's path was uncompromising discipline because its very survival depended on order. South Korea's was a relentless work ethic because it had to build itself from nothing. Thailand's was about grabbing a wave of chaotic opportunity before it crashed. And Incheon, that was pure, calculated audacity because desperation demanded a solution nobody would ever see coming.
So the common thread here isn't a method, it's a mindset. It's a willingness to embrace the unconventional when the stakes are at their absolute highest. And that leaves us with a pretty big question for our own time, doesn't it?
In a world that so often prizes safety and predictability and consensus, what miracles are we missing out on, simply because we're not willing to take that 50-to-1 shot?
Okay, I want you to imagine something. What if you woke up one morning, back in 1993, and discovered that the entire map of the world economy had been completely redrawn? Well, that's pretty much exactly what happened. This is the story of how a simple change in how we measure things revealed a hidden truth about our world, and how what we measure truly shapes what we see.
So let's just start with this wild thought. What if the global economy we all thought we knew was just fundamentally wrong? What if huge parts of the world were dramatically richer and more powerful than any of the official numbers were telling us?
And to really get a sense of how distorted the old way of thinking was, get this, in 1992, the official data from all the big banks and governments said that China's entire economy was smaller than Canada's. Now remember, China had, over 35 times the population of Canada at the time?
So, I've got to ask you, does that make any sense at all? If your immediate gut reaction is, no way, then you're thinking just like some very sharp people back in 1993 who realized, you know what? We need a totally new way to measure the world.
This massive discrepancy really brings us to the heart of the matter. See, it turns out there are two completely different ways to compare national economies. One of them gave us that bizarre picture of China versus Canada, and the other was about to reveal a shocking new reality.
So on the one hand, you have the old way, market exchange rates. This is basically just what your currency is worth when you trade it for another. But the problem, as places like the IMF started pointing out, is that these rates are kind of wild. They get pushed around by currency traders, messed with by central banks. They're just noisy. But then there's the new way, purchasing power parity, or PPP. And this one asks a much simpler, much more powerful question. What can your money actually buy right there at home? It gets that a haircut or a taxi or a plate of food just costs a whole lot less in Delhi than it does in New York.
The legendary investor Barton Biggs put it perfectly. You don't need a PhD in economics for this. You just have to travel. You know that feeling when your dollar or your pound suddenly feels like it has superpowers in another country? That's it. PPP is just the economic term for that exact feeling.
Okay, so this is the big reveal. What actually happened when the IMF crunched the numbers using this new PPP method? Well, let's just say it wasn't a tiny adjustment. It was like putting on glasses for the very first time and realizing the world was way more detailed than you ever imagined.
So this is the before picture. This is how everyone saw the world in 1992. Using the old exchange rate math, all the developing countries, we're talking 77% of the world's population here, made up just a tiny 17% slice of the global economy. It's a picture of a few very rich countries and then, well, everyone else.
And now, boom! This is the after picture. Same year, 1992, but seen through that new PPP lens. All of a sudden, the developing world's piece of the pie more than doubles to 41%. They weren't just a side note anymore. They were a massive, powerful force in the global economy.
We're not talking about a subtle shift here. This was a seismic leap. The economic reality of billions of people had been completely understated for decades. And for people whose job it is to invest money, this wasn't just interesting trivia. It changed the entire game.
Oh, and here's another kicker. Because these economies that had been hiding in plain sight were growing so much faster than the developed world, this big recalculation meant the entire world economy was actually growing 0.5% faster every year than anyone realized. In global finance, 0.5% is a huge deal.
So here's the crucial part. It's one thing to know this stuff, but what do you do with this new information? For an investor like Barton Biggs, seeing the world this way wasn't just a cool fact. It was a blueprint for a brand new investment playbook. This new perspective led to 4 huge conclusions. 1, the whole world economy was bigger and growing faster than we thought. 2, it meant that most currencies in developing countries were probably undervalued long-term. 3, and this is so important, these countries weren't as poor as the old data made them seem. And 4, their economic growth was being driven by their own people buying stuff, not just by exporting goods to rich countries. And that last point? That was the truly revolutionary idea. For decades, everyone just assumed that poor countries needed rich countries to grow. The PPP data flipped that on its head. It showed that these emerging economies were becoming their own engines of growth, and they weren't nearly as dependent on a recession in the US or Europe.
And what was fueling that engine? People. A massive,
newly visible middle class. Suddenly, the data showed China had a middle class of about 300 million people. India had one around 180 million. And these weren't just abstract numbers. These were millions of families buying their first television, their first refrigerator, creating these enormous markets right there at home.
So to make this really concrete, Barton Biggs didn't just write papers about this theory. He went hunting. He started looking for the absolute best place to put this new idea to work. He called it looking for the jewel in the crown.
And he found it. In July of 1993, while a lot of investors were chasing other shiny objects, he wrote these powerful words about India. He saw it as maybe the single greatest opportunity to bet on this new way of seeing the world.
Now, you have to understand, this was not the popular opinion. The cool, trendy thing to do in '93 was to invest in these small, exotic markets that had just opened up, like Morocco or Poland. Biggs thought they were sideshows. Glamorous, sure, but tiny. He looked at India and saw something completely different. A massive, deep market with 5,000 publicly traded companies just hidden behind a curtain of bad news and bureaucracy.
And this wasn't just a gut feeling. The hard data was screaming that he was right. India's economy was really starting to cook. GDP was growing at 6%, inflation was getting under control, exports were exploding, up 29% from the year before. The fundamental story was incredibly strong.
Of course, India still had plenty of scary headlines, political scandals, social unrest, but Biggs's real genius was his ability to see all that stuff for what it was, a sideshow. He argued that the man event was this powerful economic transformation happening underneath it all. The lesson here is timeless. Learn to separate the long-term signal from the short-term noise.
So if we zoom all the way out, this story isn't just a history lesson about finance in the 1990s. It's a much bigger lesson, a timeless one, about the incredible power of just changing your perspective.
The process he followed is actually pretty simple, but it's so powerful. Step 1, you have to be willing to question the standard way of doing things, the default measurement. Step 2, you have to go looking for a better tool, a new lens that gives you a clearer picture of what's really going on. And then step 3, the most important part, you have to have the conviction to actually act on what that new perspective is telling you.
And that really brings us to today. This whole story leaves us with a huge, and I think really important question. If a simple economic metric could hide almost half the global economy in plain sight back then, what are we fundamentally mismeasuring right now? Are we missing the true value of the digital world? Are we misjudging a country's success by only looking at GDP? What are the blind spots in our data today, and what amazing truths are they hiding from us? All right, so what if I told you the real secret to becoming a legendary investor? Well, it isn't about bragging about your wins. It's about obsessing over your losses. Today, we're going to dig into the personal notes of strategist Barton Biggs and unpack some really counterintuitive lessons from the absolute titans of investing.
So just imagine this for a second. You're at lunch with George Soros. I mean, one of the greatest investors ever. You're probably expecting to hear some epic stories of triumph, right? But no. The first thing he does is start talking about all the mistakes he's made recently. And this isn't some kind of false modesty, you know. This is a raw, direct look into the kind of thinking that builds an absolute empire.
And make no mistake, Soros was a master. I mean, to really get a sense of just how successful he was, let's just look at one number. This is what would have happened if you put $10,000 into his quantum fund back in 1969. By 1986, and this is after all fees, it would have turned into, well, this. I mean, the sheer scale of this it's just staggering. Look, 10 grand in the S&P 500 would have grown to about $45,000. That's respectable, right? But Soros, he turned that same 10 grand into over 1.6 million. We're not just talking about beating the market here. This is like playing a completely different game in a different universe. So, you gotta ask, what was his secret?
Okay, that brings us right to our first section. Let's pull up a chair with Biggs and really try to understand the character behind that kind of performance.
So here's the thing. Despite all that insane wealth, Soros had zero trace of arrogance. He lived well, sure, but not over the top. But what's really key is this rare mix of flexibility and just pure toughness. Biggs points out that he could flip a massive position in a split second if his gut told him it was wrong. And that's a skill he learned during World War II, when his family had to survive by trusting their instincts, moving from one safe house to the next. That same calm under pressure was crystal clear in 1982. Rumors are flying about a run on his fund, and what's he doing? He's in his garden, literally supervising his shrubbery. Amazing.
But you know, Soros wasn't the only giant out there.
let's meet another legend, Sir John Templeton, because he proves there is absolutely more than one way to conquer the market.
And this comparison is just perfect because it shows there's no single magic formula. You had Soros, the global macro guy. He was making these huge top-down bets on things like currencies and bonds, all based on his big picture view of the world. He even said he was burned out on stock selection. And then you have Templeton, totally different. He was the ultimate global value investor, a bottom-up stock picker, just hunting for cheap companies anywhere on the planet and then betting big when he found them.
When you look at Soros's record, you see these explosive, almost violent bursts of performance. Just look at 1985. He returned over 121% in a single year, and that was almost entirely driven by his big macro bets. It was a total high-wire act, but man, did it pay off.
Now, Templeton's path was different, but every bit as powerful. Get this. After being dead last among his peers in 1963, he goes on to finish first in 3 of the next 9 years. So his worst years are often just setting the stage for his greatest ones. That just goes to show you the incredible strength of long-term conviction, that ability to hold on when literally everyone else thinks you're nuts.
And that success, for any investor, brings us to what might be the single biggest danger of them all. It's a theme that Biggs saw again and again: the great sin of hubris.
You know, the word actually comes from the ancient Greeks, and for them, it was a moral sin. It's way more than just pride. It's that kind of arrogance that makes you think you're above the rules, that you just can't fail. And let me tell you, in the world of finance, that is a one-way ticket to destruction. Guaranteed.
There's this ancient warning, and it reveals a pattern that just repeats itself over and over again. It's what destroyed Napoleon, right? He started to believe he was invincible. It's like a disease, and it infects successful leaders, companies, and investors with terrifying regularity.
And look, this isn't just some abstract philosophical idea. It has real, observable symptoms. You see it when a leader starts thinking the rules don't apply to them anymore. You see it when a CEO just talks and everyone else in the room is silent. You see it when an investor starts to believe they've got some kind of magic seeing eye, and they don't have to do the grunt work anymore. That is hubris taking root. And it's how success breeds the very arrogance that guarantees failure down the road.
But these lessons about conviction and humility, they're not just for Wall Street. Biggs actually found the perfect antidote to hubris in a totally different arena, during a lunch with one of the most powerful political figures of the entire 20th century.
He was, and I quote, absolutely floored by Margaret Thatcher. Her thought process, he said, was just a straight line, perfectly rational and clear. No equivocating, no BS. Her decisions weren't coming from focus groups or trying to figure out what was popular. Nope, they came from a set of deeply held, hard-won convictions.
And this is a perfect example of that. It's such a clear, sharp, undeniable economic truth. That kind of clarity, the kind that's rooted in core principles, well, that's the ultimate defense against the kind of ego-driven chaos that hubris brings.
Okay, so this all builds to a final and honestly a pretty chilling observation from Biggs. It's about what happens when an entire market gets infected with hubris. And this warning, it feels like it could have been written this morning.
So Biggs had this annual conference, and he started to notice this really weird pattern. You get 50 of the smartest investors in the world in one room, and their strongest consensus bet was almost always wrong. In '82, it was oil service stocks. By '90, they were convinced U.S. banks were headed for zero. In '93, all about emerging markets. And then by '95, the big one was technology.
See the pattern here? It's always the same. There's a hot new concept, the people pushing it speak with total, absolute conviction. And then, eventually, you start to hear those 4 most dangerous words in investing. Valuations don't matter.
Which brings us to this incredible, unforgettable metaphor Biggs used back in '95. He was talking about chasing those hot tech stocks, and he said it was like being one of the winners of the last poker game on the Titanic. Sure, you might feel pretty smart for a minute, but when that loudspeaker blares, abandon ship, there just aren't enough lifeboats for everyone.
And here's the kicker. Even Sir John Templeton, remember him? The legendary lifelong bull? Even he saw the danger. He told Biggs that same year that tech stocks were just crazy and that they had already discounted growth well into the 21st century. I mean, when the ultimate optimist gets nervous, you know you're in some seriously dangerous territory.
So that leaves us with a final thought, doesn't it? We've seen the patterns of genius, we've seen the poison of hubris, and we've seen the warning signs of a full-blown mania. So the question we really have to ask ourselves now is, what are the hot concepts of today?
Where might we, right now, be playing poker on the Titanic?
Today, we're going to dive into a classic Wall Street story, one that's all about market psychology and, those giant red flags we all seem to miss? It's the really strange case of a guy they called Jim the Trigger. So let's start with a question every single one of us has asked at some point. How can you possibly know you're in a bubble? I mean, how do you spot the absolute peak of the madness right before it all comes crashing down? Well, the answer isn't some super complex formula or a secret trading signal. It's actually a lot simpler. It's about listening. Specifically listening to people who are the perfect embodiment of the market's mood. People just like Jim the Trigger. All right, so picture this. It's the summer of 1983. The stock market is just on a tear, and there's this feeling of pure euphoria in the air. And this is where we meet our main character, over breakfast, of all places. So who is this guy, Jim? Well, he's a portfolio manager, but he's got this nickname, the Trigger. Why? Because he has this hair trigger reaction. The second he hears a hot new stock story, he's in. He's always chasing the latest trend, the newest fad. He's basically a human version of herd mentality. And this is where it gets really interesting, this breakfast meeting. You've got these two completely opposite worlds colliding. On one side, you have our narrator, who's being cautious, right? He's saying, hey, the market's gone too far, too fast. It's trying to buy quality stuff, like IBM. And then you've got Jim, who just scoffs at all that. He's all about concept technology. He's saying things like stocks are for dummies, and we're buying companies. It's just pure, unfiltered optimism. And then he says it, the words that should send a shiver down any investor's spine. He says, how can it go down when there's always more buyers? You can't lose the way it is this time. That phrase right there, you can't lose this time, that's the national anthem of a market bubble. You gotta remember that line. But here's the thing. At that moment, Jim's strategy was absolutely crushing it. I mean, look at these numbers. By the middle of '83, his fund was up a crazy 45%. Our Cassius narrator and the S&P 500, they were lagging way behind at around 22–23%. So Jim looked like an absolute genius, and the careful, steady approach just looked kind of lame. But, summers don't last forever. Let's just fast forward 6 short months to December of '83. This is when all that euphoria smashed headfirst into a cold, hard dose of reality. And wow, just look at the complete flip. Our narrator's fund, the boring one, finished the year up 21%. But Jim, his fund completely collapsed. It ended the year up only 18%. He didn't just give back his massive lead, he ended up underperforming everybody. The tortoise definitely beat the hare on this one. And here's why it all fell apart. I mean, you can't make this stuff up. These concept stocks he owned just imploded for the most absurd reasons. One of his big holdings crashed when its management got busted in a tax shelter scheme. Another one, called Applied Digital Logics, cratered when its president wrote a bad check for 10 grand to a store that sells clothes for dogs. And Jim's excuse for all this? It wasn't bad management or flawed business models, nope. He said there'd been a loss of imagination in the market. And just like that, his whole psychology did a 180. The same guy who, 6 months earlier, felt like he could bench press the world was now saying he was too depressed to even go to the gym. It was a speed run from total arrogance to complete despair. Now, you'd think an experience like that, a crash that painful, would teach you a lesson for life. But for Jim, no. It just meant it was time to go find a new religion. And by 1984, he thought he'd found one. He starts this new firm called U3. And get this, the name stands for everything he used to make fun of: undervalued, unloved, and underowned. He's suddenly a convert to value investing, claiming his new Bible is Ben Graham's security analysis, the absolute cornerstone of disciplined long-term investing. It was a total shocking reversal. But was he for real? Was this a genuine change of heart? Yeah, not a chance. He actually admitted that to make his copy of the book look like he'd read it a bunch, for client meetings, he gave it to his 3-year-old to play with. So it wasn't a philosophy. It was a prop. It was just the next trend he was chasing. And of course, that didn't last long. By 1985, his value investing religion was already old news. Jim pivots again, hard.
This time, he's into risk arbitrage, betting on company takeovers. He says it's like money falling out of the trees like leaves in October. The hunt for that fast, easy money was officially back on. Okay, now let's hit the fast forward button. We're jumping to 1991. New decade, new market boom. And guess who's right in the thick of it again? Only this time, the magic word isn't tech, it's biotech.
And what about that whole value investing phase? Oh, that's long gone. He's now saying value sucks and Ben Graham was a loser. He finally admits it. He never got an adrenaline rush from buying some boring, cheap stock. He needs the thrill of chasing a stock that's already going up. The mask was completely off. He's a momentum guy, pure and simple. And this is where the story just gets wild. Look at this side-by-side comparison. In 83, it was all about concept technology. In 91, he says fundamentals were irrelevant in biotech. In 83, the IPO market was fabulous. In 91, it's a slam dunk. And that feeling of being invincible? He says the exact same thing. I feel like I can bench press the world. It's like a perfect echo across time. And then, the final, unbelievable piece of the puzzle. He gets asked about the risks in the scorching hot biotech market, and he says it, again, word for word. How can the price go down when there are always more buyers? You can't lose the way it is this time. He learned absolutely nothing. He is the perfect human barometer for peak market craziness, just repeating the same script for a brand new mania. So after all that, what's the point? What's the big lesson we're supposed to take away from the strange tale of Jim the Trigger? Well, the narrator finally figured out what Jim was truly useful for. He wasn't a great investor to copy. No, he was a perfect sentiment indicator, a human weather vane. The logic was simple. By the time Jim showed up in a sector, totally hyped up and preaching its virtues, it was the ultimate signal that the party was over, the mania was peaking, and the game was about to end. And this timeline just lays it all out perfectly. Look at this pattern. He jumped from oil stocks to tech stocks to that brief fake fling with value stocks, then to risk arbitrage, then biotech, and finally to macro trading. Every single time he was just chasing the last hot thing, arriving just in time for the crash. So here it is, the big takeaway. The narrator learned to use that feeling, that invincible tone of voice he heard from Jim, as his own personal alarm bell. He says that whenever he hears someone say, "You can't lose," a little bell starts ringing in his head, like an unanswered telephone, warning him that the top is probably very, very close. And that's really the lesson of Jim the Trigger for all of us. These manias, these bubbles, they will always come back. The names of the stocks will change, the sectors will be different, but the psychology, that invincible you can't lose tone of voice, that will be exactly the same. So the real question is, the next time you hear it, are you going to hear that phone ringing?
You know, sometimes to really get a clear perspective on your own life, you have to get as far away from it as you possibly can. So today, we're going to dive into this fascinating piece from 1980 by the late financier Barton Biggs. He actually traded Wall Street for the Kenyan Highlands, and what he was looking for was a totally different kind of value.
And this quote, it just nails it right from the start. For Biggs, this wasn't just a vacation. It was like flipping a switch in his brain. He needed to get his mind off that relentless, looping track of stock markets and financial analysis and onto something way more elemental, way more real.
So yeah, he saw this whole thing as a kind of investment, but not in stocks or bonds, nothing like that. This was an investment in his soul, in his own psyche. And he believed it paid dividends that, a week at the beach just never could. He called the safari the ultimate catharsis. And what does that even mean, right? Well, for him, it was like a giant reset button. It was a way to just blow out all the accumulated dust and debris of his day-to-day life. A deep psychological cleanse that let him escape all the pressure. Now, here's where it gets really interesting. He had this sense of urgency, even way back in 1980. He looked at this incredible, wild world and saw how fragile it was. He was basically warning people that there was no telling how long it would last. It kind of adds this prophetic, almost sad layer to his whole trip.
To really get what this trip did to him, you've got to picture the place. Biggs wasn't just, looking at Africa through a car window. He was completely immersed in it. And it all started with the Kenyan Highlands.
He actually pulls this quote from Isak Dinesen, and man, it is just perfect. This isn't some lush, tropical jungle he's describing. No, this is Africa boiled down to its very essence.
powerful, refined, and pure. It's like the very soul of the continent.
And he just paints this incredible picture of what it felt like to actually be there. The colors were ancient, like old pottery. Imagine air so fresh, he said it was like drinking cool water, like you were literally living up in the sky. And at night, just the smell of wood smoke and a blanket of stars. It's a complete sensory overload, in the best possible way.
But look, as amazing as the landscape was, that was just the stage. The real show, the main event, was the incredible drama of the animals living there.
And check out how he describes it. It's such a powerful idea. When he looked out at these massive migrations of wildebeest and zebra, he wasn't just seeing a bunch of different herds. No, to him, it was like one giant, living, breathing thing, a flowing, moving ocean of life that just went on forever.
And this scale of it all, I mean, it's just mind-boggling. He talks about giraffes moving like these long-stemmed, gigantic speckled flowers, and elephants that just walk right through small trees like they're not even there. These weren't zoo animals. This was raw, untamed power right in front of him.
Okay, so you have the huge, epic stuff, but then there were these other moments, these quiet, almost everyday scenes, and that's where he felt like he was plugging into something really, really old.
Okay, this next part is absolutely crucial to understanding his point of view. He makes it super clear. I'm not a nature guy. He hates zoos. This is so important because it means his reaction isn't some preconceived notion. It's the genuine, unfiltered shock of a finance guy seeing a world that is completely alien to him.
And he puts it this way, and the contrast is just wow. He says a zoo is like a crowded, chlorinated swimming pool. It's artificial, it's contained. But Africa? That was like being in the vast, unpredictable, fresh ocean itself.
And he started seeing these behaviors that were so animal, but also strangely familiar. He saw a warthog family that looked like suburbanites running errands, a rhino mom teaching her kid how to take a mud bath, the whole comical drama of two ostriches mating. They weren't just animals, they were characters in a play that's been running for thousands of years.
And all of this, all these big and little moments, led him to this one profound feeling. Watching these scenes, he felt like he had literally stepped outside of time, like there was no present, no future, there was only the past, playing out its ancient story over and over and over again.
But you can't stay outside of time forever, right? No matter how deep you are in the wild, the real world eventually comes crashing back in. And for a financer like Biggs, well, his analyst brain just couldn't stay turned off.
And it started with a number. And boom, just like that, we are ripped out of the safari and dropped right back into the world of economics. Before 1980, Kenya had been seeing this insane 9% annual growth, so Biggs, the investor, he starts analyzing the country itself.
And what he saw was a place of total contrasts. On the one hand, you had this incredible promise, a stable democracy, booming growth. They were even calling it the Switzerland of Africa. But on the other side of the coin, you had some serious problems brewing. The global oil crisis was hitting hard. There were strict currency controls, and it was in a really tough neighborhood. I mean, he couldn't ignore the geopolitical reality. Kenya was this little island of stability surrounded by hostile or unstable countries. He even comments on his concerns about U.S. foreign policy at the time, wondering if Washington even had a real strategy for the region. The real world was definitely closing in.
And that's really where this leaves us. This reflection from 1980 is both this beautiful personal journey and a snapshot of a world right on the edge of massive change. And his warning to not wait too long, it just kind of hangs in the air, doesn't it? It forces us to ask, looking back from where we are now after all these decades, what's left of that timeless world he saw? What's been saved and what's been lost to the march of time that he predicted was coming?
All right, welcome to The Explainer. Today, we're going somewhere special, deep into the Idaho high country. This is a place that one of literature's greatest figures called the loveliest in the entire world. We're going to explore what makes this wilderness so incredibly powerful and why some of its most amazing treasures, well, they can't be bought. They have to be earned. Think about that for a second. Ernest Hemingway, a guy who saw it all, right? The battlefields in Spain, the cafes in Paris, the waters off Cuba. And yet, he said Idaho was the loveliest place in the world. It was also here in a small town called Ketchum that he chose to end his life. That deep, almost haunting connection between a person and a place. That's what we're digging into today.
So we're going to follow in the footsteps of author Barton Biggs. After hearing Hemingway's incredible praise for Idaho, he basically said, okay, I have to see this for myself. He went out and ran, biked, and hiked all over this high country, trying to figure out if it could possibly live up to that kind of legendary hype. And the verdict? Yep, he had to agree. What Biggs found was a landscape that could be as dry as a bone one minute and as lush as a wetland the next. But it was always, at its heart, profoundly wild. So this isn't just a travel story, it's really a deep dive into what makes this land so magnetic. Okay, so our journey kicks off in the Sun Valley area. This place is the perfect example of what people call the New West. Think of it as this amazing land of contrasts, where you've got modern luxury and completely untamed nature, not just sitting side by side, but actually making each other better. I mean, just look at this. The author describes it so perfectly. He talks about foothills covered in this velvet green sagebrush, hills that seem to change color with the sky, and these deep, dark blue islands of pine trees that are just clinging to the northern slopes where they can find a little more moisture. It's like a painting come to life. And right in the heart of all this is the town of Ketchum, which has this truly one-of-a-kind personality. I mean, it's been developed so carefully that they won't even allow a McDonald's. And get this, in the fall, you can literally see cattle being driven down the same main street that's lined with fancy restaurants and designer shops. It's just this fascinating mashup of rustic history and modern polish. This feeling of freedom, it's a theme that just keeps popping up. Biggs talks about renting a bike and just riding for hours, breathing what he calls that marvelous pure air. And for him, it wasn't just a workout. He said it honestly felt like he was flying, just completely exhilarating. Now, if you want something to really put that solitude into perspective, listen to this. In 3 hours of biking through one of the most beautiful valleys you can possibly imagine, he saw a grand total of 5 cars. 5. But you know what he did see? Deer, elk, hawks, and even an eagle. It's just a different world. All right, now we're going to go deeper. We're leaving the sort of familiar comfort of Sun Valley and heading over Galena Pass. And this is where the whole landscape just transforms. We're leaving the New West behind and stepping into something much, much older, something wilder. And believe me, the shift is immediate. One minute you're in the sophisticated New West of Ketchum, and the next you're in the Old West town of Stanley, which has a year-round population of just 98 people. The boutiques and restaurants are gone, replaced by the jagged, tough-looking Sawtooth Mountains. This is the real deal, a primeval wilderness. The sense of scale out here is just staggering. From his spot at the Idaho Rocky Mountain Ranch, the author could watch thunderstorms building 100 miles away. And when total darkness finally fell on that massive valley, under this huge, luminous, starry sky, he could see only one other man-made light. Just one. It's a level of peace and isolation that's almost impossible to imagine. And that brings us to a really crucial point. Getting to the true heart of this place. It isn't about how much money you have. It's about effort. Some parts of this wilderness just can't be bought. They have to be earned with good old-fashioned physical work. So that raises a pretty fundamental question, doesn't it? In a world where you can get almost anything on demand, how do you actually get into a place that's this remote, this untouched? And here it is. The author's answer is so simple and so powerful. Money won't get you there. Your credit card is totally useless. The only currency that actually matters in the deep wilderness is your own 2 feet and the strength in your lungs. So this is what it takes. You drive in as far as you can. Then you strap on a backpack and hike for hours up into rough country, climbing all the way to 10,000 feet. And there are no trail signs like you'd see in the Alps. You have to find your own way, pick your own campsite. And what's the reward for all that effort? A breathtaking, crystal-clear turquoise lake, fed by snowmelt and surrounded by alpine flowers. A view you have truly, truly earned. But look, that kind of intense hike isn't the only way to connect with this place. Not at all. There are other incredible ways to just immerse yourself in this landscape, especially from the water, and oh man, during the spectacular fall season. So for families, or maybe for those of us who aren't quite up for a multi-day trek, there's the legendary Middle Fork of the Salmon River. We're talking about a journey over 100 miles long, navigating more than 300 rapids as the river drops 3,000 feet through these steep granite canyons. But here's the best part. With guides doing all the rowing and cooking, the author calls it an extended Victorian picnic in the West.
His kids, they said it was the best trip they ever took, period. And finally, there's the autumn. You just have to hear this description. The aspens flow down the hillsides in bright avalanches of shimmering gold. It's just a time of almost overwhelming beauty, when the whole landscape looks like it's on fire with color. Which brings us right back to this one last thought. You know, we live in a world that is built for convenience, for instant access to everything. So what is the value? What is the deep, lasting importance of a place that demands more from us? A place whose beauty has to be earned, not just seen from a car window. Yeah, that's something worth thinking about.
Making a new high on your own time. You know, that title really gets you thinking, doesn't it? It's all about pushing your limits.
So let me ask you a question, straight up. Could you climb Europe's highest peak with zero experience? I mean, really think about it. You're standing there, looking up at this enormous, ice-covered beast. You've never held an ice axe. You don't even know what crampons are for. Would you have the guts to say, yeah, I'm gonna climb that?
Well, back in 1988, a group of 14 friends decided to do just that. They just decided to find out. And these weren't some elite mountaineers. No way. We're talking about a mix of regular men and women just like you and me, who had this wild, extraordinary idea.
And what was their goal? Oh, just Mont Blanc, the highest point in Western Europe, standing at a staggering 15,771 feet. I mean, this thing is so huge you can see it all the way from Geneva. This wasn't some weekend hike, folks. This was a real, honest-to-goodness, life-or-death challenge.
All right, so before we get into their journey, we really need to understand the mountain itself. Because Mont Blanc isn't just a big rock. It's a character in the story. It has this spell, a mix of breathtaking beauty and pure, terrifying danger.
For centuries, people didn't even call it by its name. They called it Monts Maudits, the Cursed Mountains. Yeah. The whole area was just shrouded in these dark legends of witches living on the peaks and massive glaciers that would literally swallow people whole, freezing them in time. Kind of creepy, right? And this really gets to the heart of Mont Blanc's two faces. One moment, it's described as a lovely woman, with this pristine beauty that glistens in the sunlight. Absolutely gorgeous. But then the weather shifts and bam, she turns into a deadly witch. Cold, forbidding, with these deep crevasses that look like scars. It's a total personality switch.
And look, this isn't just old-timey folklore. The danger is absolutely real. On average, 20 climbers die on this mountain every single year. And here's the kicker. Almost all of them try to do it without professional guides. That was one mistake our group of friends was not going to make.
Okay, so that brings us to the big question. How on earth does a group of total novices get ready to tackle one of the deadliest peaks in Europe? It's time to talk training.
So let's just recap who we're dealing with here. We've got 14 friends, a big age range from 20 to 55, men and women. And the one thing they all have in common? Absolutely zero prior mountaineering skills. I mean, some of them trained for months, sure, but one guy's only preparation was, get this, mowing his lawn while wearing his new mountain boots. Seriously.
So they had to learn everything from the ground up. We're talking about, literally, learning the ropes. They had to master the ice axe arrest. That's how you stop yourself from sliding down a snowfield to your doom. They had to figure out how to use crampons, those spiky things you attach to your boots to grip the ice. And maybe most crucial of all, they had to learn how to move together as a team, roped up, where one slip could drag everyone down.
And the people teaching them? Phew. These were not your friendly neighborhood hiking instructors. The guides at Mont Blanc are an elite corps. Super serious. There's a great line that sums it up perfectly. On the mountain, they speak and you do. There is no discussion. That's it. End of story.
But learning this stuff in theory is one thing. The mountain had other plans. It didn't take long for it to show them the brutal, painful reality of what they'd gotten themselves into. The mountain was about to bite back. And the danger hit them fast. During the very first ice axe arrest drill, one of the group members broke 4 ribs. 4, just from practicing how to stop a fall. You could say the mountain had already drawn first blood.
Okay, what was next? Oh, just a casual traverse across a cliff on a teeny tiny rock ledge with a massive, terrifying drop right below. And what was the trick to getting across? Simple. Don't look down. This wasn't about physical strength anymore. This was a pure mental game. Their 5th day of training was an absolute monster, an exhausting, grueling climb up to 13,800 feet. They were completely wiped, and just when they thought they could catch their breath, they heard it. This thunderous roar. A huge avalanche broke off nearby, a wall of ice and snow crashing down, a terrifying, up-close reminder of the mountain's raw power.
And this quote from one of them just says it all. By the end of the day, we were exhausted. We began to wonder if we had bitten off more than we could chew. Can you imagine? Physically drained, mentally shattered, and for the first time, they were all thinking the same thing. What have we done? Did we make a huge mistake?
But they didn't quit. They pushed on. And to make things even more intense, their training got cut short by a day because of their hut reservation. So, ready or not, it was time. The official 2-day ascent was about to begin.
Okay, so day 1 of the actual climb was just relentless. It started in the morning with a tough hike from a place called Eagle's Nest, straight up a rough trail. 3 hours later, they hit the Teddy Ross hut, but there was no real rest. After that, they had to cross a snowfield and start a 3,000-foot scramble up this incredibly steep, rocky cliff. And by 6 p.m., when they finally arrived at the Guter hut for the night, they were utterly spent.
And get this, the Guter hut, where they were spending the night, is at 12,500 feet. Can you even picture that? They were literally perched on top of this immense ridge, with the world stretching out below them.
And after all that pain, all that exhaustion, they were rewarded with a sunset that was probably one of the most spectacular things they'd ever seen. The feeling was summed up perfectly. You feel as though you are on the roof of Europe. Just wow.
So now we get to the final part of their story. And this part isn't really about whether they made it to the very top or not. It's about what they found out about themselves, up there, on that mountain.
They realized something profound. This whole thing, it wasn't just about reaching a summit. It was about facing the complete unknown, about learning to rely on each other, and about smashing through their own perceived limits. The journey was the destination.
So, let's go back to that first question. Could you climb Europe's highest peak with no experience? After hearing their story, maybe you see that the real question isn't about a physical mountain at all. It's about the challenges in our own lives. So I'll leave you with this. What is your Mont Blanc?
Have you ever really thought about what it takes to push yourself to the absolute edge? I mean, long after you thought your peak physical years were behind you. Well, this is a story about exactly that. It's about stretching the limits of what you believe is possible and coming face to face with a challenge that is both completely terrifying and, at the same time, absolutely magnificent. Every epic adventure has a starting point. And this one, well, it doesn't begin with a glorious sunrise. It starts with a pretty gut-churning detail. Just picture it. The only way to get to the restroom is by walking a terrifyingly narrow path over a cliff's edge. And then, when you finally crawl into your bunk to sleep, you're literally shoulder to shoulder with a total stranger who smells, well, let's just say they've been climbing all day too. It's a raw, humbling, and kind of gross way to start a story about reaching for the heavens. But here's the thing. After all that discomfort, you're rewarded with this, a moment of pure, unfiltered joy that you just can't put into words. This is the payoff. This is why you put yourself through all the misery. And it's this feeling, this perfect mix of exhaustion and total exhilaration on top of Mont Blanc that lit the fire for the next, even bigger challenge. So yeah, with the memory of that incredible alpine peak still buzzing in their minds, the author and their friends looked for their next adventure. They set their sights on an American giant, the one and only Mount Rainier. Now, this wasn't some team of elite professional climbers. Not at all. It was this amazing mix of family and friends, a group the author fondly calls the old people and the kids. So you've got the wisdom and, let's be honest, the stubborn endurance of the older generation right alongside the raw, explosive energy of youth. What a fascinating dynamic to bring to one of the toughest places on Earth. And let's be crystal clear about something. Mount Rainier isn't just a big hill. It's a beast. It's this massive glacier-covered volcano that seasoned climbers call the single most demanding endurance test in the lower 48 states. This is not a casual weekend hike, folks. This is a battle with an absolute icon of the American wilderness. Rainier really have this wild split personality. Down low, its foothills are basically paradise. We're talking lush meadows, ancient forests, just bursting with life. But the higher you climb, you step into a totally different world.
The author calls it glacial austerity, and that's the perfect description. It's a stark, unforgiving landscape of just ice, rock, and a whole lot of silence. It's beautiful, for sure, but it is also deadly. Trying to climb this thing without a professional guide is, to use the author's word, nuts. And they're right. The mountain is basically a minefield of hidden crevasses that can literally swallow a person whole. The weather can turn from pleasant to lethal in just a few minutes, and there's a constant risk of avalanches. The guides from Rainier Mountaineering, they aren't just a nice-to-have, they are absolutely critical for getting off that mountain alive. Oh, right, so the team is together, they know what they're up against, and the ascent begins. But this isn't to climb into a beautiful, sunny morning, no. This is a journey that starts by plunging straight into the darkness. So here's how it all went down. Their journey kicks off at 10 a.m. with a long, grueling slog up to Camp Muir, carrying these heavy packs. After maybe a few hours of what you can barely call sleep, the real work begins. At 1 o'clock in the morning, in the freezing cold and pitch black, they start the final push for the summit. They hit the most infamous part, the disappointment cleaver, right around 4 a.m., just as the very first hint of dawn is breaking, hundreds of miles away. And up there, at the base camp at 10,000 feet, you could already see the toll it was taking. While the younger climbers, they managed to pass out and get some crucial rest, the older members of the team just lay there wide awake. Their bodies were already screaming about the altitude, their minds racing, thinking about the ordeal that was about to come. This is the real test of the climb, Disappointment Cleaver. It's this steep, dangerous traverse across loose rock and ice, and you're doing it in total darkness with just the tiny beam of your headlamp to guide you. It earned its name for a very good reason. This is the place that breaks people. It's a true gut-check moment that tests not just your physical strength, but your will to keep putting one foot in front of the other. But for the ones who pushed through, who conquered the cleaver, the reward was instant, and it was breathtaking. As the sun finally came up over the horizon, they were greeted by a view that just washed away all the pain and exhaustion. The entire Pacific Northwest was laid out below them, painted in these deep pinks and oranges of a brand new day. Just a moment of pure, hard-earned beauty. Now, reaching the summit, that's a moment of incredible triumph, right? But here's the catch. It's only the halfway point. The journey back down, under the harsh light of day, would turn out to be a whole new kind of challenge. 33 hours. Just let that sink in for a second. From the very first step they took to the very last, a day and a half of non-stop, high-altitude, punishing effort. It's an almost unimaginable feat of human endurance. So here's something you might not realize about serious mountaineering. Getting down is often way harder and a lot more dangerous than going up. The author puts it pretty bluntly. The descent was worse. And when you hear why, it makes total, terrifying sense. See, in the daylight, a whole new set of dangers pop up. The sun turns all that firm snow into slippery slush, which makes every single step a potential disaster. But the scariest part? Now you can actually see the terrifying sheer drops right next to you, the ones that were mercifully hidden by the darkness on the way up. That introduces a whole new level of psychological fear. By the time they hit that final stretch, the entire group was just running on empty. The last part of the journey back was a 2.5-hour stumble on what the author perfectly describes as jelly legs. You can just feel the absolute total exhaustion in those two words, can't you? So, after 33 hours of pure agony, of exhaustion and fear and pushing past every limit you thought you had, you have to ask the big question. Was it worth it? Was all of that pain, all that risk really justified? And the answer is a clear, resounding yes. That final image, it just says it all, doesn't it? Safe, sound, sitting with a glass of port, looking back up at the very same peak that had just tried its best to break them. And the feeling isn't fear or regret, it's just this profound sense of satisfaction. The struggle eventually fades, but the accomplishment, that view from the top, that stays with you forever. You know, this story isn't just about climbing a literal mountain of rock and ice. It's really about facing the mountains we all have in our own lives. Those challenges that seem completely daunting, maybe even impossible. So, as we wrap this up, the real question isn't about Rainier. It's about you. What's your personal mountain? What summit is out there just waiting for you to conquer it?
So, what could climbing Japan's most iconic mountain possibly have to do with its stock market? Well, in this fascinating analysis from back in 1991, one author connects the dizzying heights and the treacherous descents of both, and you'll see, it's in a way that's surprisingly relevant, even today.
You know, the story doesn't start with charts or numbers. It starts with a feeling, a very specific kind of euphoria, right? The one you get right after you've conquered a huge challenge. It's that feeling of accomplishment, of self-reliance. And that's what's going to set the stage for this whole journey.
And this is our stage, Mount Fuji. It's described as something way more than just a mountain. It's almost ethereal, kind of floating between heaven and earth. And this image, this quest for perfection, it's a symbol we're going to keep coming back to. So keep that picture in your mind. Now, this isn't just some poetic idea, right? It's a really arduous trek. Imagine you're there, in a small group, pretty much alone on the whole mountain. You start that final ascent at 1 in the morning. It's freezing cold, the wind is biting, and you're just pushing and pushing to get to the peak before sunrise. It is a long, hard climb.
And bam, with that one line, we're completely pivoted. We go from the thin air of the summit, and we're suddenly dropped right into the thick of high finance. You see, the mountain was the escape, but now we have to look down at what's really happening below.
Okay, so let's set the scene. We're now looking at the Japanese economy as it was back in September of 1991. Our perspective totally shifts from the peak of a mountain to the messy aftermath of a historic financial bubble that had, well, just burst.
The picture in 1991 is, honestly, pretty confusing. I mean, on the one hand, you've got some good signs. Buyers are trickling back in, bond yields are falling. But then, on the other hand, there's this deep sense of pessimism. You've got major scandals rocking the market, and the index is still down for the year. It's really an economy just trying to find its feet after a huge fall.
And this is where that whole mountain metaphor just clicks into place. This chart shows the valuation of the Japanese market compared to the US. You see that massive peak in the late 80s? That's the market's own Mount Fuji. And by August 1991, you can see just how far and how fast it had come crashing down. I mean, that descent is just staggering.
But to really get a handle on what might happen next, from that point in 1991, the author takes us on a detour, back in time. We're going to look at a ghost from Japan's financial past, the banking panic of the 1920s. He sees a really crucial parallel here.
Now, to understand this story, you first have to know about the Zaibatsu. Okay, these weren't just companies. They were these massive, family-controlled empires that basically ran the entire Japanese economy. The names are probably still familiar: Mitsui, Mitsubishi, Sumitomo. But back then, there was a fifth.
And this fifth Zaibatsu, Suzuki, was run by an absolute force of nature named Yone Suzuki. At her peak, she was a global powerhouse. I'm talking about controlling a vast empire that even surpassed the legendary Mitsu. She was brilliant, incredibly ambitious, and by the mid-1920s, a very serious threat to the old guard. But, every great empire has a potential weak spot, and for Yone Suzuki, it was this. See, instead of raising equity, she financed her massive expansion almost entirely with debt. She even took control of her own banks just to make sure the credit kept flowing. It was a giant tower of leverage built on supreme confidence, or maybe hubris.
This timeline just shows how fast it all unraveled. She's at the absolute peak of her power when her rivals decide to spring their trap. Turns out, they had been secretly funding her banks the whole time, and in 1927, they just pulled the plug. The result was instant, and it was catastrophic. Not just for her, but for the entire country.
So yeah, this wasn't just some business failure. The author frames it as a calculated, ruthless act of corporate warfare, a maneuver that was played by the old, almost feudal rules of Japanese business.
So how'd they do it? Well, the trap was patient. It was methodical. First, you secretly fund your rival. Then, you just wait, and you watch as she takes on more and more leverage. Finally, when she's at her most vulnerable, you pull all the funding at once. A bank run finished the job. It was a brutal and a brutally effective strategy.
And this quote just nails it, doesn't it? This wasn't modern finance with spreadsheets and quarterly reports. This was a clash of clans, a power play that felt like it was straight out of feudal Japan, where business was played for keeps.
The fallout was immense. The panic spread across the entire nation, forcing the government to step in. The system was saved, but Yone Suzuki's empire was just gone, wiped off the map. And the ones who benefited? Well, it was the very rivals who set the trap. The other four Zaibatsu walked out of the chaos stronger than ever.
But the damage went way beyond just one empire. The entire Japanese economy basically flatlined for years after the panic. And that was the true cost of the collapse, a long, painful recovery for everybody.
So how does this absolutely wild story from the 1920s connect back to the market of 1991 and our climb up Mount Fuji? All right, let's bring it all together. This slide lays the parallel out pretty explicitly. On the left, you've got the 1920s panic. It was caused by hubris and leverage, and it led to years of stagnation. On the right, you have the 1991 market, which is coming down from its own historic peak. The lesson from history here is a pretty stark warning. The climb back from a peak that massive can be a very, very long one. And this brings us right to the author's final conclusion. Given what happened in the past and just the sheer scale of the bubble, he argues that while a little short-term rally might happen, a true, new Mount Fuji bull market, well, that's still years away.
So we come back to this chart one last time. When you look at that sheer cliff face, from the peak in the late 80s down to 1991, you can really see the scale of the challenge. The author is basically suggesting that the market now faces its own 99 switchback trail, a long, arduous climb back up.
And that, right there, is the central metaphor of this whole thing. The thrill of getting to the summit, the speed of the descent, it's exhilarating. But the real work, the true test of endurance, that's the long, slow, grinding journey all the way back to the top.
Which leaves us with a final question to chew on. When we look at any market, it's so easy to be impressed by the epic climb that's already happened. But maybe the real challenge, the one that takes the most patience and endurance, is the long climb that is yet to come.
So what's the real cure for that professional grind we all feel? I mean, really feel? Well, today we're going to dive into a pretty powerful lesson. Something for anyone in a high-stakes career, and it all comes from the story of an absolutely epic adventure. Okay, let's start with this really haunting image from Ernest Hemingway. He writes about a leopard, right? But it's found frozen way up near the summit of Kilimanjaro, Africa's highest mountain. Now, you gotta ask, what is a leopard doing up there? I mean, it has no business being there. And to this day, no one's really explained what it was looking for. And that's the mystery we're gonna try and unravel today. What on earth could drive a creature so far from home, so far out of its element, up into that freezing thin air? Believe it or not, the answer has everything to do with the crazy pressures of our modern professional lives. So, yeah, that leopard's strange, lonely journey, it's actually this perfect metaphor for a kind of sickness, one that really hits a lot of top performers in those super intense, grinding careers. I mean, think about a world like competitive investment management. The legendary investor Barton Biggs, and we're pulling a lot from his writing for this, he said that folks in that world often suffer from two, and get this, career-killing maladies. Okay, so the first one, you've heard of it. We've all heard of it. It's burnout. But we're not just talking about being tired here. This is a deep, soul-crushing exhaustion. Biggs even says it's usually fatal to a career. You've just got absolutely nothing left in the tank. All right, the second one is a bit more sneaky, and honestly, maybe even more dangerous. Biggs had a great name for it, lock brain. You know what this is? It's when you've argued your own point, your own thesis so many times that your mind just snaps shut. It closes itself off to any other ideas. You literally can't see another point of view anymore. And look, this isn't just some personal failing. For someone like an investor, having a closed mind is an absolute catastrophe. It's a disease, as he puts it, that is very dangerous to the health of your clients' portfolios. It's a complete failure of perspective. So what do? Take a vacation, right? Go to the beach for a week? Well, here's the next problem. For most of us, the vacation as we know it, it's just broken. It doesn't work anymore. The real issue is we never actually disconnect. Ever. You can be on the most beautiful beach in the world, but your phone is right there. Email is buzzing, the news cycle is churning. You're still tethered to the office, to the market. So sure, the scenery's different, but it's not a real cure. And you can see the difference right here. On one side, you've got the typical vacation. Calling the trading room, scrolling the news. Your mind never, ever disengages. But on the other side, that's the true antidote. Being completely out of range of information, totally absorbed in something else, so your head can finally actually rewind. It's simple, really. If your mind doesn't fully disengage, then you're not restoring any of that intellectual capital you need for your job. You're not recharging. You're just working from a prettier office. So, what is the real solution then? For Barton Biggs, the answer to his own burnout and lockbrain wasn't a resort. It was an absolutely extraordinary adventure.
Yeah, he didn't go to the beach. Nope. He took 7 people, including his family, to Tanzania. Their goal? To climb Mount Kilimanjaro. We're talking 7 days, 6 nights, hiking about 70 miles up the tallest mountain in Africa. This wasn't a vacation. This was a full-blown expedition.
And what a place to choose. See, Kilimanjaro isn't just one mountain in a long chain. It's a single, massive, solitary volcano rising straight up from the African plains. It's mythic. There is just no way you can be standing at the foot of that thing and still be thinking about stock tickers. Impossible. And let's be clear, this was brutally difficult. Biggs himself said that, for his age, that week on the mountain was right up there with his first weeks at Marine Officers Candidate School. I mean, wow. That is the definition of being utterly absorbed in an enterprise. Survival is the only thing you can think about. And here's what's so incredible about this specific journey. Climbing Kilimanjaro, it's literally like traveling through every climate on Earth all in 1 week. Just imagine it. You start off at the bottom in this rich, green, equatorial countryside full of wildlife. From there, you climb up into a tangled, lush rainforest with monkeys and birdsong all around you. Then you break through to alpine meadows with these giant trees and just sweeping views of Africa. After that, it gets stark. You're in an alpine desert that looks like the surface of the moon. And finally, you hit the Arctic zone for that last freezing, steep push to the top. So after all that struggle, pushing through every single one of those climate zones, that's when you get the reward, the payoff, the thing that makes it all worth it. The final ascent, it starts at 2 a.m. in the pitch black. They go then because the footing is frozen solid. You are cold, you are completely exhausted, the altitude is crushing you. But then, just as day begins to break, you make it. You reach the Kibo summit, the very crest of the continent, just in time to see the sunrise. And Biggs has this incredible line. He says that after hours of just freezing in the dark, that feeling of the warm equatorial sun hitting your face, it was like a shot of pure whiskey. Can you imagine? Just pure, unfiltered triumph, renewal. And see, that feeling, that's the real reward. This whole thing, it isn't just a trip. It's an investment, a career-extending, performance-enhancing investment. Because when you force yourself to be that mentally and physically engaged in something so other, you fully recharge everything. Your intellectual and emotional batteries are back to 100%. Which of course brings us all the way back to Hemingway's leopard. What was it seeking up there? Maybe it was just trying to escape something down on the plains. Maybe the only way for it to survive was to go higher, to a colder, more challenging place, to get a new perspective. Kind of like the burnt-out professional who needs to escape the daily grind to find a whole new vantage point.
Look, you don't have to go climb a mountain in Africa. Of course not. But the story really makes you ask the question, right? In this world that is constantly demanding our attention, that never lets us disconnect, what's that great absorbing adventure for you? The one that will force you to reset. What is your Kilimanjaro?
Today, we are diving into a really fascinating essay from 1992 by the legendary investor Barton Biggs. It's this incredible story about booms, busts, and, well, 2 completely different kinds of investments. One is all about market craziness, and the other, it's about a deeply personal vision. Let's get into it. So let's set the scene. It's August 1992, we're in Japan, and the stock market is in the middle of this historic, painful collapse after a truly unbelievable boom. And right in the thick of it all, Barton Biggs issues this really stark warning to anyone who would listen. And this quote? This really gets to the heart of what Biggs believed. You see, everyone was getting all excited about a possible government rescue package, but he was the one in the back of the room saying, hold on a minute. He was convinced that market cycles have a mind of their own. You know, you can't just flip a switch and make them stop. Back then, the prevailing wisdom, what everyone was saying, was that Japan was just different. The commentators argued that, sure, government intervention might not work in other places, but it would absolutely work there. They really thought the government could just team up with the big financial players and, poof, defeat the bear market. But Biggs, he looked right past all that noise and went straight for the numbers. And what he saw was pretty shocking. Even after a recent rally that was all hopped up on rescue hopes, he figured out that the Nikkei index was trading at a massive 56 times its projected earnings. I mean, to an investor like Biggs, a number like that is a giant flashing red light that screams, this is still wildly overpriced. So for him, the conclusion was obvious. He saw the stimulus as a total non-event, a blip on the radar. In his mind, the piper still had to be paid for all the incredible excess of the years before, in both the stock market and in real estate. The real, painful bottom of the market, yeah, that hadn't happened yet. And then, just when you think you're deep in the weeds of Japanese finance, Biggs does something brilliant. He completely changes the scenery. So we're leaving the chaotic trading floors of Tokyo and heading to the vast, quiet, open landscapes of rural Colorado. And right here, this is where the story gets really, really interesting. I mean, what on earth could possibly connect the world's second largest economy on the verge of a decade-long slump with a remote piece of the American West? Well, the answer reveals a totally different kind of investment story. So Biggs starts to paint this vivid picture for us, describing this absolutely immense valley in south central Colorado. We're talking huge, like 100 miles long, framed by these gorgeous snow-capped mountain ranges. It's just a place of breathtaking natural beauty. He talks about it as this land of extremes. You get these massive thunderstorms and sunsets that he says linger until they break your heart. And the air is so clear you can smell the juniper trees. It's this incredibly sensory, almost spiritual place he's describing. And as if that weren't enough, at the edge of this valley is a true natural wonder, the Great Sand Dunes. We're talking some of the highest on Earth, towering 800 feet over the plain. It's a place that's steeped in all these local legends, a place that just grabs your imagination. And it's right here, in this unbelievable setting, that our second investment story begins. But this one, it isn't about stock charts or earnings multiples. No, this one is about big dreams, commerce, and a completely unexpected 180-degree turn. So rewind 5 years. 4 Japanese businessmen see this valley and have this huge vision. It was a classic commercial plan, right? Buy up about 100,000 acres of ranch land, build a massive resort with hotels and golf courses, and then fly tourists straight in from Tokyo on 747s for some golf and duty-free shopping. The whole shebang. That very ambitious, very calculated plan, it just never happened. Right as they were about to get going, the entire project took a sharp, unbelievable turn. The story goes, the local legend anyway, that one of the investors, a man named Hisayoshi Ota, had this really profound moment. He apparently fell head over heels in love with the valley and decided, I have to save this place, not pave it over. So Ota completely rips up the playbook. He buys out his partners and decides to create his own personal paradise instead. He brings in this huge herd of 2,000 bison. The Grand Hotels, they become a small 15-room rustic inn. And those 3 big commercial golf courses, they become one beautiful, informal course designed to just melt into the landscape. And this is where Biggs really brings it all home. It's the core of his parable. We've seen the financial frenzy in Tokyo and this passion project out in Colorado. So what was the actual result of Mr. Oda's dream? What was the real bottom line here? Biggs, being the financial analyst that he is, takes a hard look at the business of it all. The inn is gorgeous, the food is amazing, but there's almost nobody there. With a huge staff for the ranch and the golf course, plus the cost of a bison herd, he basically observes that financially this project has to be a total train wreck. And this just lays out the contrast so brilliantly, doesn't it? The original plan was all about calculated profit, 747s, shopping, tourists. Otada's vision was the complete opposite, wild bison, a quiet inn, an empty golf course. One was an investment for financial return, the other, well, it seems like it was an investment for the soul. So here's the kicker. Biggs doesn't give us the answer. He just leaves us with this powerful, lingering question. Is the worth of an investment just the number on a spreadsheet, like that 56 times earnings multiple in Tokyo? Or can it be something else entirely? Preserving beauty, fulfilling a personal dream, even if it means you lose a fortune on paper. It's a question that pits 2 totally different definitions of value against each other. All right, let's get into it. Today, we're pushing past the spreadsheets, the charts, and all the numbers to talk about the one thing that truly drives your investing success or failure, and that's the human mind. We're going to explore the psychological traps that can completely sink even the sharpest investors, and then we'll uncover the mental tools you need to navigate this mental minefield. So let's kick things off with a huge question. I mean, we've all seen this happen, right? A room full of brilliant people, an investment firm with just incredible credentials, and they make a decision that, looking back, seems completely insane. How does that happen? Well, it's not about a lack of IQ. It's almost always a failure of psychology. You know, the philosopher Friedrich Nietzsche absolutely nailed this. He said that while madness is rare in an individual, in a group, it's pretty much the default setting. Oof. That's a powerful idea, and it perfectly sets the stage for the first big psychological trap we need to talk about.
Yeah, we're talking about a nasty little phenomenon called groupthink. Think of it like an intellectual disease that can infect any group, especially an investment committee that's feeling the pressure. It's this invisible force that can turn a whole room of smart, independent thinkers into a single, deeply flawed mind. A Yale psychologist named Irving Yannis, he's the one who really defined this, and he put it perfectly. Groupthink is what happens when the desire to fit in becomes way more important than the desire to be right. That need for everyone to agree becomes so overwhelming that it just shuts down any real critical thought or, even looking at other options. So how do you even spot this thing in the wild? Well, you gotta look for the warning signs. You'll hear these collective rationalizations, things like, don't worry, it's just another correction, it'll bounce back. Or there's this dangerous illusion of invulnerability, this belief that, hey, we've been through this before, we're always fine. And maybe the sneakiest one is the illusion of unanimity, where it looks like everyone agrees, but that's only because people are biting their tongues, suppressing their own doubts because they don't want to be the one to rock the boat. But here's the good news. You can absolutely fight back against groupthink. The secret is to deliberately introduce some friction into the process. Leaders have to demand debate. And here's a fantastic trick. Officially appoint a devil's advocate. Their only job is to argue against the consensus and poke holes in everyone's logic. Another great move is to hold a second chance meeting after you think you've made a decision, just to give everyone one last safe opportunity to say, you know what, I'm still not sure about this. Okay, so we've looked at the internal threat of groupthink. Now let's pivot to an external one, the scam artist. See, scams don't just work because the bad guys are clever. They work because our own minds, our own greed, and our deep-seated desire to believe in a fantasy make us the perfect victims. $200 million. Let that number sink in. That's how much money just vanished in one of the most famous Ponzi schemes of the modern era, run by a firm called J. David & Company. It's just a mind-boggling amount, and it really shows you what's at stake when human psychology and high finance collide. I mean, this story is like something straight out of Hollywood. You've got Captain Money and the Golden Girls starting their firm in '79. To dodge any real oversight, they move the whole operation to an offshore bank. And for a while, the money just floods in. But then by '83, the cracks start to appear. And by 1984, the whole thing comes crashing down. So what was the bait? How did they hook so many smart people? Well, here it is. They promised virtually assured returns of 30 to 40% a year. Oh, and tax-free, of course. It was an offer that was scientifically engineered to be too good to turn down. It played directly on that incredibly powerful human emotion, pure, unadulterated greed. And here's the real kicker. The red flags were everywhere for anyone who bothered to look. The claims they were making were either totally unsubstantiated or just flat-out lies. But as the author Donald Bowder pointed out, the few people who did find these red flags, they were just ignored by everyone else. Why? Because the other investors simply didn't want to hear it. The fantasy was just too good to give up. Okay, so we've looked at the problems: groupthink on the inside, scams, and greed on the outside. So how in the world do we protect ourselves? Well, let's dive into two really powerful mental models from a couple of legendary thinkers that can literally help us rewire our brains to see the market more clearly. Our first tool comes from the one and only George Soros in his theory of reflexivity, and he uses this absolutely brilliant analogy to explain it. He says investing is like shooting at a target, but the very act of you shooting actually moves the target. Most of us think the market just reflects reality. Soros says no, our actions in the market actively change that reality. And this comparison just lays it out so clearly. The standard view, the one we're all taught, is that the market is like a passive mirror. It just reflects the underlying value of a company. But the reflexive view says the market is an active engine. It doesn't just show us reality, it helps create it. Think about a housing bubble, right? Prices go up, so people feel richer, so they borrow more money, which pushes prices up even more. See, the market is actually shaping the economy. All right, our second mental tool comes from Nassim Nicholas Taleb, and he targets a completely different enemy, one that we all face every single day. And that enemy is noise. The problem for investors today isn't a lack of information, it's that we are drowning in an overwhelming flood of random, totally irrelevant data that we keep mistaking for important signals. Now, check out these numbers, because this is where it gets really mind-bending. For a decent investor, if you check your portfolio just once a year, the probability that you'll see a profit is super high, like 93%. But look what happens when you start checking more often. Check it every quarter, your odds drop to 77%. Check it every day, you're basically at a coin flip, 54%. And this chart just drives that point home, doesn't it? The more often you check your portfolio, the more you're just staring at random market blips, the noise, instead of the actual long-term result, the signal. You get all the emotional gut punches from the daily downs without gaining any real information. As Tulip would say, you're just being fooled by randomness. So, if we're not supposed to get sucked into all the daily noise, what on earth should we be doing? Well, for that answer, we've got to turn to Warren Buffett for a masterclass in what might be the most underrated, most powerful skill in all of investing: patience. This is probably one of Buffett's most famous ideas. He compares investing to playing baseball, but with one game-changing difference. In his version of the game, there are no called strikes. The market can throw you pitch after pitch after pitch, bad ideas, mediocre ideas, crazy ideas, but you are under zero pressure to swing until you dip that one perfect pitch right in your sweet spot. But here's the trap for most people. They aren't actually playing Buffett's game. They're playing a totally different game where their clients or their bosses are the umpires, and they're calling strikes on you every single quarter. This creates this immense pressure to just keep swinging, to do something, to put numbers on the board. And that forces you into short-term thinking and, ultimately, bad decisions. So, let's try to pull all of this together. We've talked about dodging groupthink, resisting our own greed, understanding how the market shapes reality, and ignoring all that distracting noise. It all really boils down to one thing: cultivating a very specific, very rare kind of perception. You see, the ultimate skill of a truly great investor, it isn't about knowing more facts than the next person. It's about having the ability to take that endless flood of data and news and chatter and noise and distill it down into real insight. It's about learning to convert raw information into genuine wisdom. I absolutely love this quote. Winston Churchill once used this incredible phrase to describe another politician, but it just perfectly captures the mind of a great investor. It's that seeing eye, that deep, almost intuitive vision that can somehow see through the obvious, see through the brick wall right in front of you, and get a glimpse of what's on the other side. That's the goal. And that really just leaves us with one final question for you. Building that kind of vision, that seeing eye, it doesn't start by adding more. It starts by subtracting. It starts by cutting out the noise. So I'll leave you with this to think about. What noise will you turn off, starting today, to give your own seeing eye a real chance to develop?
All right, let's talk about a problem that I know hits home for pretty much everyone listening: just being buried in information. We're going to tackle it today by looking at a true master, the legendary investor Barton Biggs, and the system he built to find that little bit of signal in an ocean of noise.
I mean, does your inbox, your news feed, that pile of books you're supposed to read, does it ever feel like a tidal wave that's about to crash over you? You're definitely not alone. That feeling can be totally paralyzing. But what if there was a smarter way to handle it all?
Now check this out. That's a quote from Barton Biggs, one of the sharpest, most successful investment managers of his generation. So, if a giant like Biggs felt so swamped by information that he literally couldn't even think, well, that tells you just how serious this problem is. This isn't just about being busy. It's about losing the ability to do deep work.
Biggs had this, breakthrough moment. He figured that a staggering 90% of all the written stuff that landed on his desk every single day was, well, junk. It was either just rehashing things he already knew, or it was totally irrelevant to making smart decisions. 90%.
So where was the good stuff? The real gold, those game-changing insights that could move markets, was all hiding in that last 10%. And that's the real challenge, right? It's not just knowing most of it is noise. It's about building a system to chuck that 90% as fast as possible so you can find the 10% that actually matters.
And this quote just nails his whole philosophy. Look, the goal isn't to get to inbox zero. That's a false victory. He knew that the whole point of reading all this stuff was to make wise judgments. Every single thing he read had to serve that one purpose. Otherwise, what's the point?
So how did he do it? How did he actually put this into practice? Let's break down the first piece of his solution, his tactical day-to-day system for dealing with that constant flood of information.
Okay, for all those company and industry reports, he was absolutely ruthless. Step 1, he'd scan just the summary. Step 2, he'd ask one question. Is there even a chance of a new, fresh insight here? If the answer was yes, he'd read on. But, and this is key, the second it started to feel repetitive or stale, boom, straight into the trash can, no hesitation. He figured it was way better to risk throwing too much away than to get bogged down in the fluff.
Now, of course, not everything got that treatment. He had a few core daily essentials. He had to read the New York Times and the Wall Street Journal. And for anyone investing globally, he said the Financial Times was just indispensable. You simply couldn't get that level of international business news anywhere else.
But when it came to the weekly and monthly magazines, his whole approach changed. He didn't read them cover to cover, no way. He said he treated them with, and I love this, disrespect. He just scanned the table of contents and cherry-picked the 1 or 2 articles that looked genuinely valuable. It was all about surgical precision, not just casual reading. But here's where it gets really interesting. His system wasn't just about being fast. It really had 2 different speeds. He had that fast, ruthless filter for the daily news, but he had a much slower, deeper process for gaining real wisdom. And for that, he always turned to books.
This really lays out the 2 worlds he lived in. Daily information, the news, gives you a tactical edge for a day, maybe a week, but its value decays so fast. It's all about what's new. Books, though, books are different. They give you strategic understanding that can last a lifetime because they're focused on what's true, the fundamental stuff that doesn't change.
And here's why he felt so strongly about it. Biggs understood that his own life, his own experiences, were just one tiny little data point in the grand scheme of things. So for him, reading books was like downloading the hard-won lessons from the greatest minds in history. It was his ultimate defense against being vulnerable, against only knowing what you've seen with your own 2 eyes.
So, what books did he think were so important? Well, he actually curated and rated a whole library of them. Let's take a look at just a few of his absolute top-tier, 5-star, you gotta read this recommendations.
First on the list is a classic, and it's not really about spreadsheets or valuation models. It's about the psychology, the gut feel of the market. Reminiscences of a Stock Operator is basically the story of the legendary trader Jesse Livermore.
And Biggs's review says it all. He called it the classic book on intuitive trading. He believed your education as an investor just wasn't complete if you hadn't read it. It teaches you to feel the rhythm of the market, not just analyze it.
Okay, next up, we move from the psychology of the individual to the madness of the crowd. Biggs was a huge believer that if you don't study financial history, you're just doomed to get burned by the same fire as everyone else. And this book, Manias, Panics, and Crashes, is the ultimate study of those boom and bust cycles that happen over and over again.
His take on this one is so short but so powerful. He just called it the best scholarly analysis of the species. I mean, what more do you need to know? If you want to understand how a market bubble forms and why it always pops, this is the book.
And his 5-star list kept going. He covered everything. Books on why smart people make dumb decisions in groups, of course Ben Graham's Bible of Value Investing, The Intelligent Investor, an old-school classic on crowd psychology, even a guide to managing huge pools of money. It just shows you how wide he cast his net in the hunt for real wisdom.
So, after all that, what's the big takeaway for us? Well, the lesson from Barton Biggs goes way beyond Wall Street. It's really for anyone who wants to think more clearly in this incredibly noisy world. It all comes down to consciously, deliberately curating your information diet.
You could almost say he was like the hedgehog from that famous parable. You know, the fox knows a little bit about a lot of things, but the hedgehog knows one big thing really, really well.
For Biggs, that one big thing was knowing how to relentlessly filter out the junk to find what truly mattered.
If you had to boil his entire philosophy down into a single sentence, this is it. It's a two-part strategy. Part 1. Be a disciplined, ruthless filter for all the daily, temporary noise, the ephemeral stuff. And Part 2. Be a patient, dedicated student of the timeless fundamental wisdom, the eternal stuff, found in great books.
In the end, what Biggs taught us is that you are what you read. It's that simple. The quality of the information you let into your brain is going to directly determine the quality of your thoughts. So the question I want to leave you with is this: what's on your reading list? And is it designed to make you wiser or just more informed?